It is 9 a.m. from the Nasdaq market site in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Shauna Smith. Here is your morning rundown. Shutdown averted for now. In the 11th hour, lawmakers passed a 45-day stopgap funding bill to keep the government open. Speaker McCarthy worked with House Democrats on the legislation after hardline members of his own party refused to compromise. And now they're mad. McCarthy's message to those who are threatening to oust him? Bring it.
Plus, laser focused on the latest Fed speak. Investors are looking for any indication of the future interest rate path from Fed Chair Powell and other Fed officials scheduled to speak today. Last month's higher for longer warnings took a sizable hit on equities. September, the worst month for the S&P 500 in 2023. Will investors hear anything to calm those nerves today?
And welcome news from China. A return to growth in China's manufacturing sector, solid September EV deliveries, and a boom from holiday travel have investors feeling optimistic. The country's recovery so far this year has left much to be desired, so the latest positive data points are a welcome sign. Well, back to the government shutdown. The government narrowly averted a shutdown this weekend after passing a stopgap bill to extend funding to November 17th, which included disaster relief funds, but was missing new aid to Ukraine. So what does this mean for stocks here? And of course, as we're taking a look here at the pre-market, you've been continuing to monitor some of the futures as we have this morning. But I think most notably here, shutdown averted for many of the economists, even portfolio managers that we were speaking with last week, who were putting an 88% probability on there being a shutdown. So how does this kind of rejigger the equation here? Well, futures, at least this morning, are down across the board for the major U.S. averages. But now the larger question is, what about November? Because it sounds like we're just kicking the can down the road.
We are kicking the can down the road, and we're going to be right back here in about 6 weeks, 6.5 weeks, talking about the exact same thing.
Fun.
Likely, at least. That is a likely scenario, given the fact that the GOP is still a very divided House. But at least when we take into account how investors are looking at this, there wasn't a heck of a lot of worry going into the weekend just about the immediate market implications and what a shutdown would mean here for investors. It did offer, I think, a little bit of a sigh of relief earlier this morning. We at least initially saw that in the futures action. But now, once again, as you can see, we're looking at pressure across the board. And I think it's because, like you just said, Brad, we're going to be right back here on November 17th. So, yes, we did buy some time. But, of course, now the focus is going to be on negotiating that longer term funding deal and whether or not Congress is going to be able to do that. September was just a tough month for stocks. I mean,
it was,
the S&P and the Nasdaq both having their worst month of the year. So yes, there's a bit of a relief here, the fact that we were able to avert a government shutdown, but now the focus is back on a lot of the uncertainty that's still relevant right now when it comes to Fed policy, when it comes to inflation, when it comes to a cooling jobs picture, just exactly what that means for equities here down the line.
Yeah, and even as we think about what stalemate in Washington, D.C. looks like, and particularly where the uncertainty still lies, the uncertainty still lies within the Republican Party as well here right now. You think about the bill that did pass 335 to 91, 90 Republicans voted against it, as well as one Democrat. But then you think about ultimately what Kevin McCarthy had to say in his conference after the passing of the bill, saying that if someone wants to make a motion against me, bring it. There has to be an adult in the room. And I think for McCarthy, and now as we look towards November and what type of negotiation is perhaps set to take place, will he still be? I don't know how quickly they can look to oust a Speaker of the House, but will he still be the Speaker at that point? And that could be a larger market uncertainty.
Massive market uncertainty. Well, let's talk about all of this because Washington's 11th hour deal narrowly avoided a government shutdown for the next month and a half at least. Now, though, the clock is ticking for officials to work out a longer term solution before mid-November. If that weren't enough pressure for Speaker McCarthy, hardliner Matt Gaetz is saying that he is going to move to oust McCarthy as Speaker. For more on the battles going on right now down in D.C., we want to bring in IXIC BTIG Director of Policy Research. IXIC, it's great to see you again. So let's talk about this deal that many, at least on Friday, weren't too optimistic that a deal was going to be able to get through Congress. We did see that. So how are you looking at what was reached and really what that signals here for the next 6.5 weeks until that next deadline?
Yeah, good morning. So look, my main point to clients has been we have expected a shutdown of the government in the fourth quarter, and investors should not care. Our message to clients this morning has been the exact same. We still expect a shutdown in the fourth quarter, and we don't think the client should care. And I think you perfectly summarized it in the beginning when you said, look, all we did is what DC does best, which is punt the hard decisions, punt the hard bills to later on. And all we have here is a punt of the federal funding deadline to November 17th. Sean and Brett, we haven't addressed any of the big issues. There's still fights over spending levels, over specific policies, and of course, over that Ukraine funding, which was the trickiest part of the whole thing for everyone to figure out over the weekend.
And so, with that said, Isaac, are there any significant portfolio moves that you're telling clients or that you would advise people to consider, given the fact that there are still larger policy decisions that have yet to kind of net out one way or the other here once we get to November?
I'll tell you, the one thing that scared me the most was that we wouldn't collect and report official government data during the shutdown. I think obviously we all know it's a pretty sensitive time for the Federal Reserve, and it's nice to have that gold-plated data coming out, things like the jobs report, of course, that we'll all be focused on. So that's point number one, is at least we've got 6 more weeks of that. Point number two is there are acute areas of policy concern that have arisen with the government shutdown. So, for example, the National Flood Insurance Program. Had that lapsed, we would have been losing about 1,300 home sales a day, right? And then the Small Business Administration would have pulled back on credit availability. So there are acute issues that would have been delayed. But by and large, the biggest concern for me was that lack of gold-plated data when the Fed continues to navigate these choppy waters.
I would say there's still a lot of uncertainty, especially when you look at the GOP party, very divided right now. Matt Gaetz over the weekend coming out saying that he's going to move to try to oust Speaker McCarthy from his position. Talk to us just about that process, what needs to happen in order to do so, and I guess what the potential implications of that would be here for the market investors, just given the fact that there is so much turmoil in D.C.
Yeah, look, I'm sure that we all remember the 15 ballots it took Speaker McCarthy to get the job. And so it's going to look a little bit like that, but the tone will be slightly different in so much as the question here is going to be whether Democrats come to save him. You know, by our math, there are probably 20 to 25 Republicans in his caucus who will vote to oust him. So then the question becomes, will Democrats come to save the day? How many will do so? And when will they do so? Now, thankfully, there's always a Byzantine process that you can use in the U.S. Congress. And I think that we will see a lot of talk about a motion to table this effort that is something that you could see Democrats embrace either directly with a vote or by simply not being there and voting present, which would then lower the number of yes votes that you need to accomplish that. So there's some procedural ways out of this. My gut tells me that Speaker McCarthy will still be Speaker at the end of this week. We've yet to see any verifiable alternative come up in Republican circles. But we are going to have to deal with that sort of topsy-turvy volatility from D.C., just like we had with the speakership battle at the beginning of this Congress.
How quickly do you believe that could take place? Is it clear?
Yeah, look, I think once it's filed, the leadership has 2 days to start moving. So this is something that most folks in D.C. think will happen this week. But, you know, Brad, I'll throw this out to you. It's not just can he survive, right? And I do think he can survive this and hold on to the gavel as Speaker. I think there's then a question of how long will he really be in this seat if he needs Democratic support to hold that seat, right? And I think that's the question that a lot of D.C. insiders are asking, which is, you know, fine, he can survive this challenge, but is that really a position that you can maintain when you need 20 plus Democrats to save you?
Does he have much trust from the Democrats, Isaac?
No, this is a much different dynamic than we've had in the past. You know, we've thrown this around when we've talked about it before. The speaker and leader dynamics in the past in the House have been far more collegial, far more positive than we have here. There is a deep disdain for Speaker McCarthy within the Democratic Party. And I think that that's something that's going to make it hard for Leader Jeffries, the leader of the Democratic side, to decide how to do this. And that's why I do think the likeliest option here is to support a procedural means of stopping the effort to oust him now. But it's going to be a tough pill to swallow for Democrats that don't like the Speaker, don't trust the Speaker, and would prefer anyone else become Speaker, but sometimes there's a fear that, what the unknown could be worse than the known.
Isaac, all of this type of focus on the Beltway, and it's not even 2024 yet. So once we get to 2024, what does that spell out? How much more volatility, perhaps, or at least attention, does that place on the general election year that is set to be, and where markets might be paying close attention to that as well?
Yeah, look, I think that we have to all emotionally and strategically start to prepare for what's going to be a very long presidential election. And I think that there is such a stark divide from a policy perspective between the two major parties, let alone the candidates themselves. And so, for example, I already have clients starting to think about what a Republican White House would mean for M&A in particular, as we've seen real headwinds for M&A. For enforcement from the energy regulators to the consumer financial regulators. But it's going to be close. We've got to keep in mind, this last presidential election was decided by some 40,000 folks across 3 states. And that's something that I think that we have to keep in mind when we talk about all these big polls and everything like that. This is going to come down to a couple thousand folks across 3 or 4 states again.
Absolutely. Isaac, great insight and context as always. Isaac Boltanski, BTIG Director of Policy Research. We appreciate you kicking off the week with us. Thanks. Well, oil prices hold steady over $90 a barrel to start the month amid widespread bets that demand will continue to outpace supply. With the latest on this, we've got Yahoo Finance's Inez Ferre. Hey, Inez.
Hey, Brad. Yeah, and if you take a look at oil right now, you're looking at West Texas Intermediate that's above $91 a barrel. You're also taking a look at Brent crude that's above $95 a barrel. And both Brent and WTI had a strong quarter last quarter, up of an average of 28%. Now, there is a recent note from Goldman Sachs saying that China is seeing strong demand, robust rates of demand that basically surpass predictions when it comes to oil, when it comes to copper for China. Oil demand is up 6% year over year, according to Goldman economists. Also, remember that Goldman has predicted that oil will go to $100 per barrel in the next 12 months. You do have more bearish calls, including Citi's Ed Morse, that recently put out a quarterly print, basically saying that Brent is going to go down to the low 70s in 2024, saying that more oil is coming onto the market. So he's expecting for oil to come down this quarter and even further next year, guys.
And as I know you're also keeping a close eye here on Bitcoin on the move once again this morning, above 28,000. Lots of questions about whether or not this is the start of a rally here for Bitcoin. What do you think?
Yeah, right now it's up more than 4%. You can take a look on our Wi-Fi Interactive. Year to date, it's up 70%. So this 28,000 level, this is the highest since mid-August. So this is a 6-week rally that we're seeing. The next resistance level is expected to be about $30,000 per token. Now, you did have a bipartisan group of House Financial Services Committee members that sent a letter to the SEC. They want the SEC to approve spot Bitcoin exchange traded products listings. Also, want to note Coinbase. This is the Bitcoin related stock. Coinbase is up in pre-market. The exchange received a license in Singapore, allowing it to expand its digital token services to Singapore. And I'm just trying to find it up here right now so you can see in pre-market that it is up almost 5%, Singapore being a priority market for Coinbase, guys.
All right, money moves right there, or Bitcoin moves. Inez Ferre, thanks so much for taking the time this morning, breaking that down, tracking both of those moves. Appreciate it. All your markets action straight ahead, ladies and gents, boys and girls, live from the Nasdaq market site. We're just getting warmed up here. Stay tuned. You're watching Yahoo Finance. You have tons of great economic analysis, markets analysis as well, but you're also training for the New York Marathon. What is your number one tip for all the runners out there that are perhaps trying to get their miles in and see you when they're running throughout the 5 boroughs here in New York later?
Yeah, well, first of all, you have to be really determined to do it. Do not give up, because as much as it can be very painful and exhausting, When you get through that, you feel great. So just keep going and keep training with consistency. You can't slack off, so to speak. You got to do it every other day, I would say, or every 2 days, and really put in the work. You'll make it.
I'm Shauna Smith alongside Brad Smith, and this is Yahoo Finance Live from the Nasdaq market site. We got just about 12 minutes here until the opening bell on Wall Street. Here with a closer look at some of the downward movement that we're seeing ahead of the bell. Jared Blickery. Jared.
That's right. I'm looking at the sector action, only energy. By the way, the background coloring is from Friday, and those little rectangles at the bottom, that's what's happening today. Only energy, just barely in the green for 3 basis points. But consumer discretionary, materials, industrials, healthcare, utilities, financials, all of those down, 1/3% to about 0.8%. So seeing some more downside continuation off of that weakness we saw last week. Now here's the Nasdaq 100, where we're seeing a little bit more green. In fact, Apple just barely positive, so is Microsoft. NVIDIA up 0.9%, but Tesla, we've been talking about that, down 3%, and we're expecting their deliveries pretty soon for the prior month. Let's go to the EV section to see if we can see any trends underway right here. Li Auto up about 0.5%, NIO down 0.75%, seeing some mixed action among Toyota, Ford, GM, so not really seeing anything there. Let's check out our leaders, and here we can see cannabis leading to the downside. That's MJ, followed by solar and regional banks. So interesting crew there, rounding out the bottom three. In the upper left, we have Baito. That's a Bitcoin ETF, just talking about that with an S4A. No need to double down, but we do have a number of ETFs, especially Ethereum, coming to market today, so we're going to be tracking that. Finally, just want to close on energy. I did mention that was in the green. You can see for the majors here, more green than red, except for Exxon. That's down about 0.1%. And guys, thank goodness it's October. I think we can all look forward to a brand new month of surprises ahead, whatever that means.
Yeah, spooky surprises in some cases. I mean, we know, Jared, October is known to many as jinx month for investors. So very quickly here, what does this mean for volatility and big returns?
Yeah, good point there, because I've been talking about volatility, how we tend to see volatility spikes in September, in October, and when we see volatility spike, well, that usually means that stocks are rolling over to the downside. I have the 10-year T-note yield up here just to show you the incredible trend underway since May. We don't see any sign of stopping here. The higher for longer mantra playing out in the markets, and every time we start squeezing higher, pricing in new higher rates, that does seem to affect equities to the downside, and I think that's what we saw not only in September, but also October. Here's a look at the VIX, what the VIX is doing lately. We did have that spike up, but I'll tell you what, for all of the hype around the sell-off that we just had, that barely reached, 5-6% in the S&P 500, we didn't get a VIX print above 20. So really, historically, still depressed when we're talking about volatility. And then here are some slides that I have to show you what we can expect month by month. This purple line down here, well, you can forget about that because that's September. That is in the rear view mirror. Now we're taking a look at October, which is this cyan line that I've tried to trace out there. It does have a pretty volatile track record, and that's because we've had a lot of market crashes that affect the averages. Those VIX spikes that I'm talking about, well, a lot of those have happened in October. Thinking back, for instance, to the Great Crash of 1987, you can go all the way back to the 1930s. I think the Great Depression was kicked off with Black Monday in the markets then. I do want to say that the S&P 500, given the strength that we had through July, notwithstanding the fact that we rolled over the last 2 months, sets up a pretty bullish picture for the end of the year. October looking pretty good, November, December, all of that, we'll have to see how it plays out. But more often than not, we do see stocks going up into the end of the year when we have that strength in the beginning. I'm going to close with our look at the seasonality of the VIX and still looking for a potential high into October 12th. That would mean a little bit more downside potential in the coming week or two. We'll have to see how October plays out in the markets. But guys, I'm looking forward to another day here.
All right.
We played out.
We are as well.
We all are.
Jared, thanks so much. Stay with us for the opening bell as well here. We won't have to wait a full day for that one. We're going to keep our eyes on the EV space, though, in the interim this morning as the delivery numbers hit amid the ongoing price war in China. Now, NIO, Li Auto, and XPeng delivering a total of 66,831 vehicles in September. That's a jump of 116% from the same time last year. NIO alone delivered 15,641 vehicles in the month. That's a 43.8% jump on the year. The big winner, however, appears to be Li Auto, with its numbers outpacing those two rivals here. You're seeing shares moving higher pre-market fractionally for Li Auto here. I think the important thing, too, is to remember, we mentioned at the outset of this conversation, was the pricing wars that have really initiated in China to try and make sure that you get consumers into the vehicle ecosystem for a lot of these major auto manufacturers within the region, trying to make sure that if they can get them into that ecosystem, perhaps you can get them as part of that larger brand affinity base going forward as well.
Yeah, certainly. That's going to be a huge focus here. We know that the price wars are really sparked by Tesla. We also just got those delivery numbers out as well. But the price wars having an impact when it comes to demand, helping demand in China as we talk about this transition to EVs. When you talk about Li Auto being one of the outperformers here of the most recent quarter, analysts expecting third quarter revenue to come in above about 245% up on a year-over-year basis to $4.6 billion on the heels of indications of strong demand here from these monthly sales data that we've been getting over the last several months. But NIO, Li Auto, and XPeng combined is selling just over 66,000 vehicles in the month of September. That's up 116% year over year, the second best month on record. And switching our focus here and talk about Tesla, because we know there was a lot of focus on these delivery and production numbers. Third quarter total deliveries of 435,000, just over that. Production of 430,488. That was the decline from the previous quarter. That slide that we're seeing comes as Tesla did close some factories here. That, of course, having an impact on production and has slowed production. So certainly a mover to the downside, not a big surprise on the heels of these delivery and production numbers that we're getting from Tesla, off just about 2.5%.
And yeah, that's so key. I mean, when you think about the 3 and the Y, which really make up the majority, almost all of those production and delivery figures, you strip out the S and X, which are really just about 13,000 of the production figures, 16,000 of the deliveries here. All that considered, it shows that people are continuing to gravitate towards the mass market offerings here. And on a regional basis, that's amazingly important because it's the entry point for a company like Tesla in so many of these international markets, China, but also Europe as well here. And so even as you're thinking about the success rate of the 3 and the Y going forward, it's a larger question of, okay, at what margin can investors expect Tesla to continue to be able to sell these vehicles, deliver these vehicles? And that's going to be the more important and critical, perhaps, figure that investors pay close attention to.
We know that it's been slashing prices for many of its models really since the start of the year. Markdowns as large as 34% for the Model X. So significant pricing discounts here. We'll see what those results look like here in the coming quarters. All right, Coinbase, a mover today, moving to the upside after the Singapore arm of the largest U.S. crypto exchange received a license to offer digital payment token services in the city-state. Now, it had received initial approval last year. In a statement, Coinbase saying that it identified Singapore as a, quote, vital market for its business. In terms of the rollout plan there, Coinbase saying that it's going to take a measured approach, is going to be a bit more cautious on growth going forward, and they're going to focus on having a sustained and viable business.
Yeah, additionally here, I mean, thinking through Coinbase, and we got the kind of crypto update earlier on today. Of course, the larger thing for Coinbase continuing to move forward, even though they got this payments license in a new country, it's all about utilization. Where does utilization beyond having people that are able to buy and sell cryptocurrency or perhaps even store it? And storage is perhaps going to be the next major item that a lot of people think through, whether it's hot storage or cold storage moving forward. Coinbase being one of the major companies that offers that going forward. I think that's going to be part of the revenue base, but again, just the type of transactions that they're able to see in other regions as well. That's going to be one of the things that investors can continue to evaluate here. We also want to talk about AMC Entertainment stock that is trending this morning. The theater chain operator has struck a deal to put Beyonce's Renaissance World Tour movie on the big screen. The move to work directly with the artist and her Parkwood Entertainment label comes hot off the heels of a similar deal with Taylor Swift. It's set to release the Eras Tour concert film on October 13th. And coming into the chat now, hot from his own Eras Tour experience, we've got Yahoo Finance's own Jared Blickery. He was there earlier this year. You were early to this game. Deep value on Taylor Swift.
Oh, thank you. I was there in Phoenix. I think I'm the only one in the country who managed to get one over on Ticketmaster. I didn't get my ticket, so I ended up buying a second set at ridiculously low prices, and that was the last time anybody ever got a deal, I think. I'm trying to go back, but I'll tell you what, the overseas tickets are looking pretty scarce right now. I'm looking at meme stocks in the pre-market here. We did get some movement last week. Let's take a look at the 5-day price action, and you can see kind of a mixed board right here. I'm seeing some movement in Coinbase, not only last week and this morning. We're just talking about that. Looks like Carvana is down fractionally, not seeing too much in the way. I look at meme stocks in the same way I look at some of the other fringier parts of the market. Could be this solar ETF down here. Could be Korean stocks. It could be even Chinese internet stocks, which seem to be having their own case of fundamentals. But when we take a look at the price action for the market overall, as we just wrapped September, I just want to point out that over the last 2 years, we came down exactly, this is the Dow. I want to show the S&P 500. We came down just about right where we would have expected to. And it looks like we got the opening bell in just a second here. But it would be perfectly rational for the market to bounce from here. Notwithstanding what I was saying about October, I think we see a little bit of weakness in the next couple of weeks. But let's take a look at the Nasdaq and see, just kind of track just kind of track how things are opening up here. As we've been saying, I've been watching Apple. Apple kind of broke down over the last week, and we're going to see if that was just a false breakdown or if we pop up back ahead and try to race to new highs. But Apple tends to lead the way, and looks like we're finally opening up here. So let's take a look at some of these prints. All right. So we're looking at the sector action on the Wi-Fi Interactive. Communication services is in the lead. Energy, which was the leader in the pre-market, well, that is now in the red, but just a little bit. Utilities took a hit last week. We saw that is an interest rate sensitive sector. That was taking some lumps last week as we saw rates heading higher. Consumer discretionary, XLY, now racing to be the line loser of the day, followed by consumer discretionary, materials, industrials, real estate, healthcare, all of those on the bottom line here. Let's take a look at some of our leaders. I mentioned solar. That's taking a little bit of a hit here. Aside from Bitcoin, which is up about 5% from Friday, we're not seeing too much in the way of dark green motion here. A little love for IPOs and meme stocks. And then just checking in on the energy sector, which was flashing some signs of green. Not a whole lot of green here, mostly red, but again, not too much dark red, just kind of meandering down below the unchanged line, guys.
All right, Jared, thank you so much for that update real quick here as we get to the opening bell on Wall Street here. Things have commenced for the new month and new quarter as well. We're watching the opening bell. We just saw the opening bell. WholeLogic and Kellanova, rang the opening bell at the New York Stock Exchange. All right, well, switching gears, Sunnova, shares in Texas-based solar power company Sunnova Energy pushing higher this morning. UBS initiating coverage of the business with a buy rating and a $16 price target. Good news in the sector has been hard to find as solar stocks have had a tough ride lately, thanks largely to higher interest rates, policy, and that is weighing on demand for sure here. I want to bring back in Jared because, Jared, some of the catalysts here that were cited in this note, particularly the ongoing release of state-level solar approvals data, and then additionally new installations here as well. You're taking a look at some of these energy names here on the day.
Yeah, besides the peculiarities of one particular player in the energy market, especially the alternative energy market, a lot of what happens in energy comes down to the price of crude oil. And so I just wanted to track that real quickly. Let's see if we can pull off some of these night quotes and just get a pure look at what's happening inside the market here at some of the futures. But crude oil, WTI just hit a handle of about $93. And here we're looking, it's up about 20 basis points. Here's the overnight price action. But when we take a look at the year to date, pretty clear that's been trending up over the last 2 months. And that is in the light of the fact that the dollar has also been trending higher. Ines Ferre was talking about this a little bit earlier. There's kind of a virtuous, or maybe it's non-virtuous, circle of higher oil, which is priced in dollars, attracts dollars. And so both of those can be bid up at the same time at this point in the business cycle. Oil tends to spike later than everything else. It tends to spike and top out later than stocks, for instance, once the Fed is rolling over. And not to get ahead of myself to say that we're in that point just yet. We're kind of looking at the Fed standing pat, but that is what is expected to happen because it happens historically. I think it was late 2007, the global financial crisis, that oil topped $150 per barrel, and that was the all-time high. So just taking another look at the sector action here, it looks like energy is settled into a 14 basis point loss here, and what we're seeing is tech. Tech is emerging along with communication services in the lead. And let's take a look at the mega caps because some of those sectors are represented here. NVIDIA, which is representing tech, and Apple, each of those up more than 1%. Apple just barely there. Alphabet is representing communication services, and that's up 1%. Tesla, which is in the consumer discretionary camp, along with Amazon, that is down 2%. So some mixed action to begin the week in the mega caps, but a little bit of a turnaround so far because a lot of these names were in the red when we opened up just a few minutes ago, guys.
All right, Yahoo Finance's own Jared Blickery. All heat maps matter here. Thanks so much, Jared. Appreciate it. All right, guys, all your markets action straight ahead, live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance.
Good morning.
morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Well, as we start October, the leaves are changing colors, the weather is getting cooler, and it's nearly earnings season. Consumer spending has stayed resilient, but rising rates are leaving many investors spooked. So what can we expect from the markets and earnings this season? We want to bring in Abby Yoder, JP Morgan and Private Bank U.S. equity strategist, to tell us what to expect this next couple of months. So Abby, great to see you here. I think a lot of investors at this point, we're coming off of the weekend where we were able to avert a government shutdown, at least for now. Investors, though, there's still a lot of uncertainty out there. How should we be thinking about the setup here to the last couple months of the year?
Yeah, I mean, I think what's really interesting is that we had this this burst of optimism throughout the summer, right? And then we had the Fed come out, and it seemed like it was going to be not necessarily higher rates, like 6 to 7%, but higher for longer. Mm-hmm. And that rate uncertainty is exactly what's driven the market down the 6.5% from the highs that we've seen. But going forward, I think there's kind of been a vacuum of macro data. We did get inflation data last week that was encouraging, right? Like that is a big part of our more optimistic pillar, is the fact that you are convincingly seeing inflation come down. But I think to your point, like going forward, we have earnings starting next week, which will be very important. We had a lot of conferences over the course of September that were actually pretty positive, but I think they were lost in a lot of the macro noise. And so getting to hear companies for the next couple of weeks as we head through earnings season will be very important. And I think, and this isn't something we necessarily always focus on, but seasonality is a big part of this. And September is historically the worst month for the market. So going forward, a little bit more of that seasonal positive aspect too.
Earlier this year, in kind of earnings seasons past, it's been AI has been a major theme. It's been the resiliency of the consumers after that. Is there a magic word for this earnings season?
That's a good question. I mean, I think everyone's, to your point, really focused on the consumer, right? Like it's, and what I find interesting, it's very easy to make the bull and the bear case for the consumer. Very easy, right? Like you can pick and choose from different company earnings report, from different data, and say it's good or it's bad. And I think from our perspective, when you put the whole picture together, right? So everyone points to the savings rate as being the big, canary in the coal mine. It's very much lower than it was during the pandemic, which we all have expected. But when you think about the fact that wages are still positive now on a real basis, they weren't last year. And the consumer balance sheet coming into this was much healthier than it had been in the past, right? Like consumers had paid down a ton of their debt over the past couple of years. So thinking from the starting point, yes, you're seeing delinquencies come up, but from very low levels. So putting it all together, the consumer still does look very strong to us.
How much of some of this uncertainty that we talk about, the fact that Jay Powell once again reiterated this, or really laid out kind of this higher for longer scenario, we might be in this higher rate environment, maybe longer than we had initially anticipated. How much of that has been priced into the market, given the move to the downside that we saw in September?
I mean, I think a 6.5% pullback. We're at, north of 4.6% on the 10-year. I think that's driving all of it right now. I really do think that's because it's all multiple contraction, because you're actually seeing positive earnings revisions, right? You're seeing, that's what's being kind of lost, I think, through all of this noise, is the fact that on a forward-looking basis, you've seen earnings revised higher. And that doesn't typically happen at this time of year, really. And so I think it's all been multiple contraction, and I think it is tied to that rate move. And we're going to hear from Jay Powell this week, which I think will be very important. But I think, at this point, there's less than a 50% chance baked into markets that you see a cut by July of 2024. I mean, I think there's room maybe for upside there in terms of the market pricing.
Does the Fed continuing to be hawkish initiate any type of major portfolio repositioning from your perspective?
Yeah, I mean, I think that makes it's difficult, right? Because if they continue to be more hawkish in the sense that they're going to raise rates a lot higher from where they are now, you've seen those really defensive sectors like utilities and staples and real estate really, really hurt because of this move in interest rates. But on the flip side of that, valuations are much more attractive. And if they continue to hike higher and stay there longer, that means a recession is probably more likely. So that would be a more interesting opportunity, I think, in terms of the more defensive sectors, whereas right now, we're a little bit more cyclically oriented in nature.
I mean, how difficult is it just trying to gauge the best investment opportunities, where we're headed next, given all the uncertainties, given the fact that we've heard time and time again that this scenario is playing out right now? It's unlike anything really that we've seen in the past.
Yeah, I mean, this year is just kind of like emblematic of that, right? Like coming into the year, 100% of economists thought we were going to be in a recession, 100%. Yeah. And it's still very high, right? Like I think that's very much up for debate where, the economy is going. But I think, having a balanced approach in terms of your equities, like growth and value, you've seen a huge swing over the past 2 years. If you just own them both over the same time or over longer periods, it ends up working out, right? I think right now, like I said, we are much more optimistic in terms of our equity outlook. We foresee the market hitting all-time high or new all-time highs by June of next year. And all of that's driven by earnings, right? It's all fundamental in nature. And so when we're thinking about like what we want exposure to, it does tend to be those more cyclically oriented parts of the market. So consumer discretionary, for example.
Yeah, and that goes to how far out markets are often looking as well here. When you think about how far that is, and you're already thinking about June of next year, what would be the top idea, like let's say 2023 is done. 2024, what is the top idea that your team is already evaluating, that's already kind of brewing right now?
It is, we just upgraded consumer discretionary this past month, and I think it's really actually very controversial, right? Because you have all of these like bears coming out saying that the consumer is slowing, which we do agree with, it's slowing, but from very, very fast, from very high levels. And the way that we think about it is we have this concept of what we've been calling a rolling earnings recession. It's where different sectors of the S&P 500 have gone through their earnings recessions at different times, right? And it has to do with the pandemic, right? Supply chain disruptions, different lockdowns happening, the shift from consumer goods to consumer services. And so what we've already seen in the consumer discretionary sector, particularly on an equal weighted basis, because you know that there are two companies that make up a large part of that, it's actually already been through that that earnings recession period. And so you're starting to see they've already done cost cutting initiatives. And so thinking about that, a reacceleration on the top line, but also having margin, they've had margin support in the fact that they've already cut costs. That's why we're more positive on the consumer discretionary sector.
Abby, great to have you here in studio with us. Thanks for coming out to Times Square, Yahoo Finance Live here this morning. Abby Yoder, JP Morgan Private Bank, U.S. equity strategist, joining us live in living color. Thanks.
Thank you.
Appreciate it. All your markets action straight ahead. Stay tuned. We are live from the Nasdaq market site. You're watching Yahoo Finance. Thanks to a short-term stopgap bill, the government can stay open through mid-November. But notably absent from Saturday's last-minute deal, additional funding for Ukraine. President Biden pressed Republican leadership on Sunday to back an additional bill, providing more aid to the nation, saying he fully expects Speaker McCarthy to keep his commitment to pass additional funding. Joining us now with what's on his radar, we've got Rick Newman. Hey, Rick.
Hey, guys. Well, it's good news that the government continues to operate. But the reason that this deal got through is because they excluded further aid for Ukraine. And that is the wrong issue to play chicken with. So what's probably going to happen here is there will be further action down the road within the next few weeks. Congress probably will approve most or perhaps even all of the ongoing Ukraine aid Biden is asking for. But this is a bad look. And this is honestly exactly what Russian President Vladimir Putin wants to see. He wants to see dissension in the United States, among the leadership in the United States. He wants to see political fragmentation and fracturing over this issue because his big bet is that Joe Biden will lose re-election in 2024. President Donald Trump will become president. And Donald Trump has basically said he does not support aid for Ukraine. And he has said he will solve this problem in 24 hours, which basically means he will cave to Putin, withdraw all U.S. aid. And if the U.S. aid goes, then a lot of the European aid goes, and the international support, this very strong coalition of support for Ukraine, basically crumbles. And for people who are saying to themselves, why should we care about Ukraine? There are very compelling reasons to care about Ukraine, even if you don't care about democracy in Ukraine or you don't care about democracy in Eastern Europe. Look, we're spending a grand total of about 5% of the defense budget to help Ukraine and provide military support for Ukraine. What do we get for that? Well, we have two big geopolitical foes, Russia and China. And for that 5% of the defense budget, Ukraine degrades Russia's military power every single day. It weakens Russia's global political power every single day. And we're getting a great return on that 5% of the defense budget. By the way, no American troops are there in Ukraine doing any of this. All we're doing is providing money. I could go on and on why this is money well spent, but we need to show better unity. And I would love to see President Biden, frankly, be more forceful and more clear, telling Americans why we need to continue this funding.
Rick, do you really have any hope, though, for more unity inside the Beltway, given the fact that even within the parties, it's so fractured, let alone reaching bipartisan agreement?
I mean, look, there's nothing wrong with some dissent, or certainly, I mean, it certainly is appropriate for some members of Congress to say we need to have strict oversight, make sure that this money is going off for it. I mean, I'm all for auditing all the spending. And if some people want to, they oppose it. I mean, you're never going to get 100% support on anything. The problem we have in Congress is because of the weird structuring of the weird configuration of the House at the moment, where Republicans just have this slim majority. You can have as few as 10 members, 10 radical Republicans hold up important legislation, which is what happened here. Now, again, there are mechanisms to get this funding through in other ways. But opposition is one thing, but when you have tyranny of the minority and it's a very small group of people that is holding up something that ought to be a national priority, that's not right. So this is why I say I think President Biden could do some work here and make a stronger and clearer case to ordinary people. Maybe it needs to be a primetime address from the White House or something like that. But make the case for why this really matters, instead of what he's been saying all along is, we will support Ukraine for as long as it takes. That's basically all he says. How about explaining why we're doing this, why we need to continue doing it, what kind of outcome we need to see, and actually saying we're in it to see Ukraine win, just to prevent Ukraine from losing. I think he has not done that. And I think that gives some of these radical Republicans more wiggle room with their own constituents.
We'll see if the president is able to do that and whether or not his message gets across to Americans. Rick Newman, thanks.
Bye, guys.
We'll keep it right here on Yahoo Finance. We've got all your market action ahead live from the Nasdaq market site. We'll be right back.
Congress did end the student loan payment pause. Bills will be going out as payments are due in October. And we're really encouraging people to take a look at all of the affordable repayment options. We've created the SAVE plan, which is the most affordable repayment plan ever. We already have 4 million people in it.
The first thing we would advise any student or family that's managing student loan debt is not to wait. The time to be thinking about repaying your student loan debt is today, not waiting until the last moment.
President Biden and his administration is committed to taking action in order to relieve student debt. The president has also announced a Plan B under the Higher Education Act and will hopefully be able to provide borrowers even more relief.
Because we've had such a long break, so a lot of people don't even know exactly how much they owe, who their lender is. And so for some people, it starts with answering those basic questions.
The cost of attaining a higher education degree has become unaffordable and unattainable. And so we really do need to look at common sense solutions, ensuring that states are able to adequately fund their higher education.
Women earn degrees at a higher rate. They're enrolled more in college. So they've taken on more degrees. They've taken on more debt. Then they emerge with a degree and they are earning less. And unfortunately, it takes them longer to pay off that debt.
The president is trying to put into place things that will help people who go to college. And we should be really helping people go to college and doing it in an affordable way.
I was a high school math teacher right out of college, and I got my first contract for $29,000 and thought it was like $1 million. For most folks, they know today that not that much, and you can't actually kind of afford to live off that money. Really kind of contributed to feeling a little bamboozled kind of by the system itself.
I think the number one thing is, generally speaking, we tell people not to fall victim to people calling you and asking you for advice. If it sounds too good to be true, it usually is too good to be true.
Everybody thought that student loans of all stripes persist through bankruptcy, but in fact, certain private student loans do not. And we brought a lawsuit to try to stop Navient from collecting on those loans for thousands of people, and we're successful.
What we're hearing from a lot of employers and from a lot of students are questions about mental health, about well-being, and student loan repayment is part of that conversation as they think about their financial well-being. So all of these types of benefits are becoming more the norm as a new generation comes into the workforce.
I think these are important questions that families are asking now when they're looking at the potential of taking on student loan debt. What's the long-term return on investment? And that's what folks are asking.
So the real question to ask isn't whether it's good or bad debt, it's whether I can pay it back and whether it will be sustainable after I invest in myself.
We have a survey at Prince Review called College Hopes and Worries. The #1 survey for the past 7 years running has been concerned about assuming too much debt to pay for college.
For loan borrowers, they may not feel that the loan itself is worth it, but the education is.
The education is really important, but people are going to have to start asking, is it even worth taking out these loans because it's just so expensive?
self-driving cars. For years, we have heard the hype around autonomous vehicles, but the latest advances in tech have accelerated the timeline, bringing what's next, the future of driverless cars, one step closer to mainstream.
This is Yahoo Finance's Next. I'm Pras Subramanian. Today we're focusing on driverless cars. The global autonomous vehicle market is projected to reach $614 billion by 2030. That's up 61% from the $104 billion generated in 2022. As the race for autonomous vehicles picks up speed, trials are underway in cities across America. GM's driverless unit Cruise has 15 trials in the US, and Google's Waymo is operating in 2 cities as well. It's been a long road to get here. So when will driverless cars go mainstream? It all comes down to new technology. The processing power of AI, companies like NVIDIA with new cutting-edge chips for faster processing. Tesla's Dojo supercomputer, which aims to train autonomous vehicles on a much larger scale. And even new sensors from companies like Mobileye that promise to perceive the road like never before. The biggest players, those are the companies you all know. GM, Ford, Tesla, and Google. But a few startups are making big waves in the space. So buckle up and come along for the ride.
Well, one of the companies making major strides in the world of vehicle autonomy is May Mobility. Now, the company says that their multi-policy decision-making will take its self-driving vehicles to the next level. As Pras sticks with us and sits down right here. All right, let's talk a little bit more about how this all works. With every move a vehicle makes, May Mobility's MPDM technology calculates every possible scenario in the blink of an eye. The technology then decides what the safest course of action is, directing the car to slow down, brake, or stay the course, all in real time. May Mobility's technology is already bringing self-driving cars to a select few cities across the U.S., with plans to soon expand in California. May Mobility's co-founder and CEO Edwin Olson joining us now. Pras still here to talk about the latest when it comes to self-driving cars. So Edwin, just walk us through exactly where things stand with May Mobility and how you are changing the game when we talk about autonomous driving.
Yeah, absolutely. So May Mobility, we develop our own self-driving technology, as you mentioned, based around multi-policy decision-making. We integrate it on vehicles like those behind me, and we sell long-term transportation contracts to businesses and governments. And what this allows us to do is to create a gentle on-ramp for the technology. So we don't have to solve every driving problem on day one, but we can grow our technology bit by bit.
And so how close are we to seeing this eventually get to critical mass, or at least where this technology is already being invested in, and especially from the efforts of May Mobility, where you're seeing that start to be fast-tracked in different regions?
So we're really focused on building the business part of autonomous vehicles, not just building research and development prototypes. So we believe that the first markets will be the ones where the unit economics are the strongest. Those tend to be in municipal and business deployments, where the revenues can be quite high, but you can also control a lot of the costs that would otherwise accrue to the vehicle. So where will this start? It's going to start in cities. It's going to start where buses maybe are underperforming. And you'll see this, it's already started in 4 cities for us, and you'll see many more in the near future.
Edwin, this is Pras. Question for you about your technology. How does it differ than what, let's say, Cruise is doing, or maybe even Google's Waymo?
Yeah, one of the advantages that we have here is that this is not my first time building autonomous vehicle technology. I've done it 4 times now, which is the nice way of saying that I've gotten it wrong 3 times. And the general approach of trying to go and build a set of edge cases that can catalog everything that might happen to a car, it just doesn't work. You need to have an underlying technology that can allow the vehicle to deal with new situations that the engineers did not think of. And that's exactly what multi-policy decision-making does. It's a simulator on the car. Think of it like an imagination, where we are literally imagining hours of driving every second to figure out what the vehicle should do next.
So Edwin, are you guys kind of more focused on, or why are you guys more focused on sort of the fleet operators as opposed to, let's say, individual cars like a GM or Toyota sedan?
That's a great question. So, there's really two sides of this. What does the product look like, and what does the go-to-market strategy look like? I think there's been a lot of convergence around what the product looks like. It's probably going to look like a Lyft or an Uber kind of service where you pull out your phone and a car comes to you and takes you to your destination. It's super convenient. Riders love that. But then the go-to-market strategy on the sort of robo-taxi side, the revenues tend to be very low. Whereas for cities struggle to provide really high-quality transportation, especially in less population-dense areas. But they spend a lot of money on buses. A typical city bus costs $150 an hour to operate. And we can provide better service to those areas with fleets of our vehicles rather than big buses driving around empty.
So Edwin, your technology is already being deployed. How is it being received so far?
One of the questions we get a lot is, will people get into an autonomous car? And one of the first things we learned is that if you're solving a real pain point for a rider, adoption's not an issue. So a lot of our riders are otherwise waiting out at a bus stop for a bus that may or may not come. It might be freezing cold outside. If you drive up to them with a warm car that's ready to take them directly to their destination, they love it. They'll jump right in, and adoption has never been an issue.
Edwin, how do we avoid some of the pitfalls where we've seen kind of these mass traffic jams because of improper reading or improper sensing of environments?
Yeah, it's a real challenge. I think to zoom out, one of the questions I ask myself every day as I'm commuting in is, would the world be a safer place if they were all autonomous vehicles rather than human-driven vehicles? And you see people drifting over their lanes, not paying attention. These are not problems that autonomous cars have. I would take that autonomous future in a heartbeat over what we have today on our roadways. Now, that said, autonomous vehicles are not perfect either, and they're going to have places where they perform well and sometimes places where they are not as smart as humans. I think the key question, though, is, are they doing net good? And I think we are at the point where autonomous vehicles do net good.
Edwin, so talking about net good and talking about, you guys are based in Michigan. I went to U of M, so go blue, of course. But I got to ask you, the state really kind of in focus here with the UAW and strikes happening. Do you think that there's a possibility that we might see more jobs because of autonomy, or will they take away jobs, for instance, of bus drivers?
Yeah, we think that autonomous vehicles are actually good for labor. If you think about how many people struggle to get to work on time, and oftentimes it's because the public transportation infrastructure that they depend on doesn't serve them very well. And so we see ourselves as being an asset to everyday workers who just are trying to get to work on time, trying to get home so they can spend time with their families. And along the way, we're going to create a lot of really excellent jobs. The kinds of jobs that we're creating are higher wages. We do a lot of education and outreach to our communities as well. I think this is a situation that's going to really improve the situation for labor.
Edwin, so I understand you guys are partners or strategic partners, with Toyota. How is that going? What are you guys doing as you work together?
One of the most important things is safety. And the only way that you can really guarantee that a vehicle is safe is to understand how all the pieces fit together, from the sensors to the software to the hardware. And that requires collaborating with an OEM where you can trade notes and work closely on a day-to-day basis. That's the kind of relationship we have with Toyota. You see the Siennas behind me. These are our workhorse. We also have started development on the e-Pallet, which is a really cool, larger battery electric vehicle. And this kind of partnership is critical to delivering a great product.
All right, May Mobility co-founder and CEO Edwin Olson. Exciting work that you and the team are doing. Can't wait to check back in the future.
Come for a ride. Thank you.
Oh, we will. We're going to take you up on that. Absolutely. Thanks so much, Edwin. Well, market leader Tesla is working on the next big thing in autonomy, the production of its supercomputer Dojo. The revolutionary system promises to supercharge the deployment and training of autonomous vehicle technology. Pras, what more do we know about the infamous Dojo?
So unlike other companies or other automakers, Tesla actually made their own supercomputer, and they originally made one with NVIDIA, and then they decided, we need more power, we need more kind of technology, we need more processing, computing power, we got to make it on our own. So they worked with another chip maker to make their own supercomputer called Dojo, like you mentioned. And what that thing is going to do is it's going to use Tesla's AI model to train it's autonomous self-driving technology. And basically what it does is you have all these cars, robotaxis all running around cars like your Tesla Model 3, for instance. It's collecting data and sending it to Dojo. Dojo is getting that video data, it's labeling it like, what is this, a car, this is a sign, this is a human being. It then learns how to interact with that person or thing. Then it sends those instructions to your car, or there's another computer there that then learns and trains, it gets more instructions and gets better and better. That's sort of the theory as to how they're going to use supercomputers and AI to sort of make driverless cars work. Now, we're a long way from that actually being a reality where we're in a car with a pod with no pedals, no wheel. But I think that's sort of what Tesla believes is the future for their sort of development of AI, or self-driving.
Just to follow up on what you just said there, just in terms of we're far away. I guess how long? For people that aren't closely following this sector, when we're trying to figure out how real this next, or how likely this reality is, what does that timeline look like?
You know, a couple of years ago, people thought we would have that right now. And what's happening is the challenges are way more complex than I think programmers and developers and experts believed or thought, because there's just so many things happening on our roads and more bikes, more people, other autonomous cars. So that problem is more complex, I think, than what people thought. And now they're sort of trying to, okay, how do we take a step back? Ford, for instance, pulled the plug on their Argo AI with Volkswagen because they said, you know what, it's more about automatic cruise control, like that sort of thing. It's not about like driving in cars everywhere by its own. So that's sort of where we're at. And I think other companies like Cruise and also Tesla are saying, no, we can actually get that. We can go there.
And we know certainly many analysts on the street are very bullish on Tesla's Dojo, exactly what that means for their business. Is this a technology that maybe could be used outside of vehicles when we talk about other use applications for it?
You know, you could talk about boating. I've been on the boat. I've been in the water recently. There's that. There's possibility for, I've seen motorcycles that might use autonomous technology. You can just hop on a bike and it takes you. So yeah, there's definitely. I mean, aviation already has it. Yeah. You know, aviation already has it. So it's just question is it's harder on roads. So where should investors look to cash in on the craze? Well, I spoke to Sam Schwartz, founder of Sam Schwartz Consulting and author of the book, No One at the Wheel, Driverless Cars and the Road to the Future, alongside Dan Ives, Wedbush Senior Equity Analyst, about the future of investing in self-driving cars and what some of the biggest hurdles to the industry are at the moment. Take a listen.
Yeah, I think one of the biggest roadblocks is convincing the public that they need it. A lot of people may wonder, why do they need autonomous vehicles? They're doing just fine driving. One of the most compelling arguments is the reduction in traffic crashes. And there is a false argument that 94% are due to driver error, when in fact the National Transportation Safety Board says that is not the case. And it's a mistake by the previous administration in using that false statistic. Right now, the average driver would not get into a fatal crash until driving 80 million miles. That's a lot of miles. And if we're talking about in Europe, it's closer to 200 million miles. Can the autonomous vehicle, if the goal of it is to reduce traffic crashes, do better than one fatality every 100 or 200 million miles? It would have to do that. So a big obstacle is the public. The public is also reacting in San Francisco and some other places and not liking to see autonomous vehicles on their streets. There's the environmental issue, the ecological issue, and others that are being raised, and some of them are taking to guerrilla warfare, putting obstacles in the way of autonomous vehicles, putting traffic cones on them. They're yet to be perfected, but there is what I believe to be a big market there, particularly with autonomous transit. And I think that's a sleeping giant, and we may see more of that coming up.
Hey, Dan, so sticking with safety here, do you think sort of Tesla, with some of its public perception, some of its issues with accidents at emergency sites with self-driving are kind of a sticking point too for consumers?
Yeah, well, first of all, those are interesting stats, super insightful. I mean, look, for someone that lives in New Jersey, I'm glad every day I don't end up in the hospital or to live another day. So a lot different drivers in New Jersey and New York. So, it's, look, but to that point, I think it's a matter of when, not if, from a self-driving perspective. We believe by the end of the decade, you're going to have about 1 of every 5 cars in some form will be autonomous. That's huge flex to muscles for Tesla, for Waymo, Aurora, and others. And I think this is all part of the fourth industrial revolution that plays out.
Hey, Sam, so what are, in your mind, some of the big companies that play in this space that people should be on the lookout for?
Yeah, the big companies, of course, Waymo is probably in the lead at the moment. And GM Cruise is certainly there. As Dan mentioned, Tesla, of course. But one of the problems with a lot of this industry is the lack of sharing of information and data. And so we really don't know enough about how these vehicles are performing. And while I don't disagree that perhaps 1 out of 5 will, by the end of the decade, will have some degree of autonomy, and many of them, in fact, have some degree of autonomy right now with Super Cruise and others, I just think it's going to be a little tougher for the average American to take a vehicle perhaps without a steering wheel, when in fact it can't do everything that a driver can do. I think we're probably 20 years away from being able to go on dirt roads, going on mountain roads and other kinds of things. But for everyday driving, I think by the end of the decade, you're going to see quite a few, and 1 out of 5 is a pretty good estimate on the road.
Yeah, we have different levels of autonomy here, from things like you said, Super Cruise, to potential of robo-taxis and things like that. So Dan, putting your investor hat on, what do you think are some of the big plays here? Is it the automakers, or is it even like chip makers like NVIDIA and companies like that?
Well, I think it's similar to what we've seen with AI. I mean, there's derivative plays from the chip perspective in terms of, when you look at that ecosystem from a self-driving and autonomous and who plays there, that's throughout Asia as well as the US, NVIDIA, and others that are going to be going after this market. But then ultimately, it's really, I think the first derivative, it's going to be the OEMs. I think that's where you look at Tesla. I think ultimately Uber is actually a tangential play, because we believe not just 1 of 5, potentially 2 of every 5 Ubers end of the decade could be self-driving autonomous, basically no driver. And then you're going to look at the commercial side, in terms of some of these commercial plays. And I think Sam brings up GM. I do think that's really important. I think Cruise is a significantly undervalued asset at GM. And for anyone that's done any sort of test drives there in San Francisco, it's eye-popping in terms of that technology.
Sam, I want to talk to you about, you mentioned something about big picture, mass transit type of autonomy. What did you have in mind there? And maybe are there any companies that are working in that space?
Yeah, there are a number of companies that are working in that space. And I think some of the sleeping giants out there could be military companies. Robotics Research has teamed up with Flyer, and they're looking at autonomous buses. Much of Europe at the moment is not accepting autonomous cars, but will accept autonomous transit. So I think that's a big play, particularly in Europe. Beep is a company that takes other technologies and manages a system, an autonomous bus system. They're doing some work in North Carolina and Florida and other places. There's May Mobility and others that are providing shuttle services. So I think there's greater acceptance there. I question to some extent the Cruise model and the Waymo model. After all, Uber and Lyft, it's tough for them to make a profit, and they got rid of their self-driving technologies. At some point, it may be well into the 2030s before we see very profitable autonomous taxis out there, Ubers, Lyfts, and the others.
Hey, Dan, one last question for you. We're in the midst of a big UAW strike that's happening now. The automakers are sort of in flux with the EV transformation. We're also talking about here self-driving. What does the sort of prospect of self-driving technology and changes to cars mean for those auto workers and in large part for the traditional automakers as well?
I think it's a clouding of worlds that's going on. When you think about electric vehicles, you talk about self-driving in terms of Cruise, you look where the GMs, the Fords are trying to go. And I think also it's a risk to the UAW, it's a risk to the union. I think it's going to be a battle. Because why these union sort of shops battle each other, you have companies like Tesla, Rivian, foreign automakers that's going to come. Look what Waymo's doing today. And I ultimately believe Apple. We believe Apple Car 2026, and that's really going to go down the autonomous front. So it's really a colliding of the worlds right now, and that's why it's either adapt or be left behind.
I like that colliding of the worlds. Either it's going to happen now, later. We have workers in flux, companies in flux, tech, big tech coming online. So we'll see what happens. Sam Schwartz of Sam Schwartz Consulting and Dan Ives Webbush, thanks again for joining us. So basically, a lot of the investing sort of story is, do companies like Tesla, which is more pure play on of course EVs, but also on autonomous and technology, versus a GM, which has a number of different businesses, but it does have Cruise, is the best play here. I think you also are looking at, like I said, the chip makers like NVIDIA. I think those are sort of your bigger sort of, who am I going to bet on when driverless technology finally comes here?
Certainly a lot of opportunity, it sounds like, for investors trying to profit off of this transitionary press. Thanks. We'll keep right here on Yahoo Finance. We've got all your market action ahead live from the Nasdaq market site. We'll be right back. Stocks are mixed this morning as we kick off the first trading day of the fourth quarter, also the first trading day of October. But what can investors expect from the notorious Jinx month? Yahoo Finance's Jared Blickery joining us now with more. Jared, give us some tips.
All right, let's go to the Wi-Fi Interactive and chart the current day's price action first, and we can get into what we might expect in the future. Here's the Dow that we're looking up right now. Only the Nasdaq is green, and we'll see if I can get some of the other markets. There we go. Well, looks like a little operator error there, but anyway, the Nasdaq Composite has gone from negative territory into the green. There we go. And also, I want to chart what's been going on with Apple. Today in particular is really loved by tech and the mega caps. Really interesting because we also have the 10-year T-note yield elevated. But back to my original point, let's go to Apple because within the last few days, we broke down below this support line, which could have been support, and we have come right back up to it. And I think this is a do or die moment because if we were to close above this line, let's call that somewhere around 175 just to be safe, we probably have a false breakdown right here, and that portends a rise to the most recent highs, which are actually record highs. If we decide to sell off from this area, probably a lot more downside, and I would expect the tech sphere to follow suit. Also want to track track NVIDIA because this stock is off of its recent lows here. It's settled into a trading range after its most recent earnings announcement. In fact, that was the record high for that stock, $499, right after that earnings print the morning after. And we can see right now just kind of treading water up to almost the 50% pullback of this current trading range right here. So not a whole lot to speak of with NVIDIA. I can also track Meta. I was following that with Alyssa Coram over at IBD on Friday, and this stock is just in a sideways trading pattern as well, right in the middle. So some of these stocks at the Rubicon, like Apple, and I think the price action is going to really make a difference today, and some of the others, price action probably doesn't mean too much. Although I would say with NVIDIA finally taking the lead again, maybe the AI trade will have some legs again, because it kind of fell off when we got that huge rise in interest rates from or after that last Fed announcement. So here's the chip space right now. Applied Materials also up 1.5. Not seeing too much red, although notably AMD, big competitor to NVIDIA, is down 0.25%. If we take a look inside software, we're seeing a little bit more red in this area. Let me sort by equal weight, and you can see it's about 50-50 between the winners and the losers here. Teladoc down 1.7%, Atlassian 1.5%, balanced out by Zscaler up in the upper left, up about 3.33%. And let me finally get to the sector action of the day. We got utilities. That is the biggest loser. That's down 3.3%. I think that has to do with the elevated interest rates that we're seeing today. But as I said, that doesn't happen to be weighing on those mega caps.
All right, Jared, we got to leave things there for right now. Thanks so much for that update here. Also, everyone, stocks kicking off the first trading day of the fourth quarter. It's a big week for economic data. The September jobs report, that's on tap. Yahoo Finance's Josh Schaefer joins us for a breakdown of what's to come this week and the excitement level that we should have kicking things off. Josh.
Yeah, Brad, we'll go 7 out of 10 this week, all right? We're pretty excited.
Oh, wow.
Of course, well, we thought at one point we weren't going to get this jobs report on Friday, or at least I thought at one point we weren't going to get this jobs report on Friday. That's a large part of what I do here, Brad. I like being busy. And so we do have this calendar now filled out for the week. And you take a look there, you see a lot of updates on the labor market. That's really your story of the week here when you think about that JOLTS report on Tuesday, jobs report on Friday. Also some interesting data out this morning, though, as far as ISM factory picking up. That we're going to get a look at services on Wednesday. On the corporate side, not a very busy week, but I'm interested to see what we hear from Tilray on Wednesday. We know cannabis stocks have been hot with legalization maybe heating up a little bit there as far as safe banking goes. And then also Levi's and Constellation will be interesting to follow on Thursday. But again, the real story of the week here is that jobs report. So I just want to give you guys again the numbers, at least as of Monday, for what we're expecting. We're expecting non-farm payroll additions of 168,000, unemployment rate of 3.7%, and an average hourly wages of 4.3%. So that unemployment rate would come down just a little bit from 3.8% last quarter. And that's going to be something that's interesting to watch because remember, we had that big tick up in the unemployment rate from 3.5 to 3.8 with the August jobs report. And that was an interesting thing to see because it really, what it told us was there was more people coming back to the labor market looking for work. Do we still see that developing during this report is going to be something I'm watching for on Friday.
All right, Josh, thanks so much.
The government shutdown was averted, at least for now, with the government now being funded through November 17th. Will Congress be able to come to a compromise in just a little over 40 days? Or will we have a larger constitutional crisis on our hands? We want to bring in Steve Clemons, Semaphore founding editor at large. Steve, it's great to see you. So I guess your reaction to what played out over the weekend and what we could expect in the coming weeks. Lots of questions still.
Well, we went from nail biting. I think we talked about this before about, what were going to be the signals of how this might go. And I said, watch Matt Gaetz, watch Marjorie Taylor Greene, because their backbone in this is very strong. Their incentives, particularly Matt Gaetz, he's really thrown down the gauntlet to Leader McCarthy and kind of called it right. That ultimately essentially needed the Democrats to kind of bail out the nation. It's not just bail out Speaker McCarthy, but in fact, they came around and kind of showed how you could move to, the side, these others. But, we don't know what Kevin McCarthy's going to have to pay the Democrats for this moment. But it came down to the wire on Saturday. We were all watching, and this continuing resolution came out of nowhere. And I don't know if I was watching Dome Watch to look at the votes as they were coming in, and you could sort of see as they were swimming in, overwhelming Democrats, and then a lot of Republicans came in. So that those Republicans that came in are going to, be the ones that are going to be the bulwark, if you will, of the moderate part of the Republican Party. But Matt Gaetz is furious right now. We're going to see what he does this week.
I don't know that I've seen him happy before, Steve, quite frankly. So now that he is so
furious. I saw him at the Barbie party once with his wife, and he looks
really
happy.
now.
Yeah.
Interesting. We're going to need more detail on that in the future. In the meantime, though, I mean, how expeditiously do you expect now some of the more upset kind of faction of the Republican Party to push for the ousting of Speaker McCarthy?
Well, you mean Matt Gaetz is I think he's thrown down the gauntlet this weekend. Of course, he said that, in his conversation with Jake Tapper, that this would happen this week. And he says he has the votes to at least move the motion to vacate, to call. Of course, he can do it. One member of the House can call for the motion to vacate. But now it will come down to something really interesting. And that's why we've already heard AOC come out and say she is not going to vote to keep McCarthy in place. But Nancy Pelosi is telling everyone, wait till you hear from Hakeem Jeffries, because Hakeem Jeffries and the Speaker may work out something. We don't know what that would be, and we don't know what the price is that McCarthy would have to pay for some Democrats to support him. But it's historic. I mean, we just never see moments like this where members of one party might, in fact, keep McCarthy in place, of the opposition party. So we don't know, but Gaetz is committed to bringing this action this week.
Steve, what do you think the risk is here? Not only, obviously, to Speaker McCarthy and what this could mean for him personally, but more broadly speaking for the GOP party as we look ahead to 2024 and the dysfunction that we've seen play out over the last, obviously, several weeks, but really several months when we talk about this divide within the GOP?
Look, parties in power have a hard time when they have thin margins. I tell everybody when the Democrats had a 50-50 balance and they needed Kamala Harris, it gave Senator Manchin, enormous power. And in my book, Manchin used that power to bring the price tag of the IRA and the Build Back Better package, which later became called the IRA, brought that all and essentially brought it down from $6 trillion where Bernie Sanders started to about $500 billion, or $500 billion. And so when you kind of look at that, he used that leverage in a way to kind of focus, if you will, and to also limit government spending. What you're seeing now are Matt Gaetz, Marjorie Taylor Greene, and the others that Speaker McCarthy has put on the Rules Committee and others, giving them enormous power in the deal to become Speaker after 15 ballots, remember, when he was elected. And they are now using that same kind of leverage. But sometimes, sometimes it's for their own personal issues, and sometimes it's for genuine concerns about fiscal responsibility, Ukraine funding, or other things. But I think right now, the Republican Party is in the midst of a civil war. But remember, the Democrats had Nancy Pelosi. We haven't seen Hakeem Jeffries in the majority yet, but he's got different wings in his party, too, that can be very dramatic. So these tensions inside parties are not just inside the Republican Party. It can happen with the Dems, too. But when you're in government and you're responsible, it's a very, very tough case if you don't have enough votes to get around the minority with all this power that's constantly threatening to defect.
Yeah, Steve, when we think about how big of a deal this could be again in November, we were speaking with Isaac Boltanski from BTIG earlier in the show, and he was remarking on some of the larger policies that had not been netted out as a result of just passing a stopgap funding bill here. So how much more pain could we see, potentially economically even, if we were to continue to look at November now and have to evaluate whether or not there will be a deal at that juncture?
Well, look, I think when you don't pass appropriations bills and you don't have democracy working to generate the appropriations bills to appropriately and craft and sculpt the way in which taxpayer dollars are being spent to move the interests of the nation forward as agreed within our democratic process, then you're really undermining that. But we haven't played that well in a very, very long time, not just now. I think the bigger interesting things are Moody's and Fitch's basically sending the signal that they're going to begin downgrading, the treasury assets and whatnot of the nation, the bonds, because they see a governance challenge and governance problem that plays out over and over and over again. So I don't know. I mean, I do think that there's no easy story here that gets better on November 17th. We'll see if both sides are able to come together. We'll see if Kevin McCarthy will survive that long in his role. And we will see whether any of those, 10 to 20, Freedom Caucus members that are, driving a hard bargain for their support are going to be more satisfied with McCarthy by November 17th. Otherwise, we may see this showdown all again.
All right, can't wait. Steve Clements, Semaphore founding editor at large. Thanks so much for taking the time here to break this down with us this morning, and we'll be in touch before November.
My pleasure.
Thanks. All your markets action ahead, live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance.
Welcome back to Yahoo Finance Live. I'm Brian Sozzi on the floor of the New York Stock Exchange, and a big day for one of the most iconic food companies in this country, if not the world. That is Kellogg. Joining me now is Kellanova CEO Steve Cahillane. Good to see you here. And I guess it's a new era for me here, bringing in a new chapter in my career with this mustache. But Steve, talk to us about this breakup of this company. I know 18 months. I've been following your journey into doing this. What does this new era essentially entail?
It entails growth, Brian. So this is about the next chapter of what we call shaping a growth portfolio. We're now driving our growth portfolio. So if you think about our business, starting today, we're now 80% snacks and emerging markets. We're led by 5 iconic brands, your own Pringles being the biggest brand, Cheez-It, Pop-Tarts, Rice Krispies Treats, Eggos. These are all brands that are growing very, very nicely. They're all highly differentiated. They're iconic. We have a very exciting international business. 30% of our business is in emerging markets, countries like Nigeria, where we have a tremendous competitive advantage, countries like Brazil. So a very exciting new era for us. It's really about growth. It's about growth for our share owners. It's about growth for our people. It's the next chapter.
Talk to us about the work to get to this point, the human component. Where are people staffed? What do the manufacturing facilities look like?
Yeah, so we still have a huge manufacturing footprint all around the world, a number of plants here in the United States, a number of plants really everywhere we do business. We're very local. We have local supply chains, so plants all through Latin America, plants all through Asia. I'm actually heading to Thailand in a couple of weeks to do a groundbreaking for a new Pringles facility in Thailand. We're adding a Pringles facility in Mexico. We're full in Jackson, Tennessee with a Pringles plant. So a manufacturing footprint that spans the globe.
Why break up a company like this?
We really think that the best way forward for our cereal business, our North American cereal business, is for them to be a dedicated team focused on North American cereal with their own strategy, their own balance sheet, their own access to capital. So that's what we've done today. KLG starts trading today as an independent, North American focused cereal business. And we think the markets will appreciate that. We also think they'll appreciate the Kellanova story for what it is. I mean, we love the Kellogg history, obviously. When people say they work for Kellogg, immediately they're greeted with a smile, but they're also greeted with, oh, you're the giant cereal company. And Kellanova is something very, very different. Still cereal internationally, but really, as I said, a snacking-led business with brands like Pringles and Cheez-It and Pop-Tarts that will really now shine through.
Is this about unlocking value? And I asked that because I remember you were also the one that sold, Keebler's? That came under your watch too. So you've been making a lot of changes to this company. Is this about ultimately just extracting the value in an iconic company like this?
It's about shaping the portfolio so that we're really aligned where the best growth opportunities are. So when we sold some of the Keebler assets, so think about the cookies, pie cones, crust, fruit snacks businesses. They were third and fourth share positions. They were not growing, and we really didn't see a competitive advantage in our ownership. We found an owner that really likes those brands, that would invest in them in ways that we wouldn't, because our best investment opportunities are some of those big 5 brands that I mentioned, as well as our emerging markets, our international businesses. So it is about unlocking growth, and it's about capturing that growth and that value for our share owners.
You've mentioned what appears to be a big push into Pringles. Is that how you're coming out here blasting as a public company, focusing on expanding Pringles around the world?
Yeah, Pringles can be found virtually everywhere in the world, and we're unlocking the growth through this additional capacity that I mentioned, because we're really selling everything that we can make. We're at capacity. So continuing to drive our international business and the business here in North America. But equally, Cheez-It was always just a North American brand until just 3 years ago. We launched it in Canada. Now we've launched it in Brazil, and this year we launched in Mexico. Next year we'll be launching in Europe. So Cheez-It, we're only scratching the surface for what that brand can do.
Some of the early analyst coverage on the company says we're unsure if some of these brands like a Cheez-It, Pringles, they have more growth left to them. What does your innovation pipeline look like?
Our innovation pipeline is robust. I mean, if you think about where we've been since the pandemic, it's been about getting your product through the supply chain and onto shelves, your core brands. There was no room in the factories really for innovative new products because it was about getting your fill rates to where they need to be. We're now really back to where we were, even stronger than pre-pandemic. So our 2024 pipeline for all of our big brands is robust, stronger than it's ever been.
There's been deal activity popping up here in the snacks business. Smarker picked up Hostess. Are you viewing Kellanova as a platform to make deals?
Yeah, our organic opportunities, as I already mentioned, are fantastic. And so as we think about our capital allocation, we'll be growing organically with those new greenfield sites that I mentioned, but our balance sheet is very strong. We paid down debt all through the pandemic. We have a leverage ratio below 3, about 2.8. And so we've got dry powder for the right acquisitions. We'll be disciplined buyers because, again, we compare inorganic opportunities with the great organic opportunities we have. But we'll be active. We'll be looking.
A lot of debate in this country about inflation. Where is it? Where is it headed? How do you see it in your business?
Yeah, so if you think about the last 18 to 24 months, it's been unprecedented. We haven't seen this level of input cost inflation. We've taken 30% price in the last 2 years. That's like taking 2 decades worth.
Steve, that's huge.
It's huge. And so as we stare into 2024, luckily, we're not looking at that same input cost inflation. There's obviously commodities that are up. There's equally commodities that are down. Wages are up. We think that's a good thing. That's sticky. But we're looking at a more benign environment in 2024. We'll have the wraparound benefits of pricing that we took last year, this year, first quarter and second quarter. But as we look at next year, we're looking at a much better balance between volume and price.
Before I let you go, we've talked for a number of years, and I don't often really get to talk to an executive doing a transaction like this, iconic company, over 117 years old, about that. How has this weighed on you personally? I can't imagine this is something you have taken lightly. I can't imagine you've slept a lot over the past 18 months.
No, I thank you for the question. It's been humbling for me because you don't take something like this lightly. It's such an iconic company. You know, I'm privileged to stand on the shoulders of giants who came before me. And so I really thank my team because together, you know, we've created this new vision for the company. 18 months of work like I've never seen before. My leadership team is the best I've had the privilege to serve with, and they've brought us through the, you know, to this day in a way that is just very, very inspiring to me personally.
I'm not sold on wearing a mustache. I'm just not going to be that guy. I appreciate the effort here, but I used to have one in high school. I can't go back to it. Steve Kaline, CEO of Kellanova. I almost said Kellogg, but Kellanova. Good to see you.
Great. Thanks for having me, Brian.
All right, much more ahead on Yahoo Finance. Do stick around.
Federal student loan payments are back, and Yahoo Finance has you covered in our series, Student Loans, Smarter Strategies. We spoke with experts about preparing for those repayments and a look at how we got here in the first place.
Congress did end the student loan payment pause. Bills will be going out as payments are due in October. And we're really encouraging people to take a look at all of the affordable repayment options. We've created the SAVE plan, which is the most affordable repayment plan ever. We already have 4 million people in it.
The first thing we would advise any student or family that's managing student loan debt is not to wait. The time to be thinking about repaying your student loan debt is today, not waiting until the last moment.
President Biden and his administration is committed to taking action in order to relieve student debt. The president has also announced a Plan B under the Higher Education Act and will hopefully be able to provide borrowers even more relief.
Because we've had such a long break, a lot of people don't even know exactly how much they owe, who their lender is. And so for some people, it starts with answering those basic questions.
The cost of attaining a higher education degree has become unaffordable and unattainable. And so we really do need to look at common sense solutions, ensuring that states are able to adequately fund their higher education.
Women earn degrees at a higher rate. They're enrolled more in college. So they've taken on more degrees. They've taken on more debt. Then they emerge with a degree and they are earning less. And unfortunately, it takes them longer to pay off that debt. The president is trying to put into place things that will help people who go to college. And we should be really helping people go to college and doing it in an affordable way.
I was a high school math teacher right out of college, and I got my first contract for $29,000 and thought it was like $1 million. For most folks, they know today that not that much, and you can't actually kind of afford to live off that money. Really kind of contributed to feeling a little bamboozled kind of by the system itself.
I think the number one thing is, generally speaking, we tell people not to fall victim to people calling you and asking you for advice. If it sounds too good to be true, it usually is too good to be true.
Everybody thought that student loans of all stripes persist through bankruptcy, but in fact, certain private student loans do not. And we brought a lawsuit to try to stop Navient from collecting on those loans for thousands of people, and we're successful.
What we're hearing from a lot of employers and from a lot of students are questions about mental health, about well-being, and student loan repayment is part of that conversation as they think about their financial well-being. So all of these types of benefits are becoming more the norm as a new generation comes into the workforce.
I think these are important questions that families are asking now when they're looking at the potential of taking on student loan debt. What's the long-term return on investment? And that's what folks are asking.
So the real question to ask isn't whether it's good or bad debt, it's whether I can pay it back and whether it will be sustainable after I invest in myself.
We have a survey at Prince Review called College Hopes and Worries. The #1 survey for the past 7 years running has been concerned about assuming too much debt to pay for college.
For loan borrowers, they may not feel that the loan itself is worth it, but the education is.
The education is really important, but people are going to have to start asking, is it even worth taking out these loans because it's just so expensive?
Taylor Swift is breaking the internet again after attending her second Chiefs game in a row last night, extending her overall impact on the U.S. economy to football. Total audience for the Chiefs-Jets game exceeded 24 million, and ticket sales spiked 175% on platform StubHub, making it the second highest-selling game of the NFL season. Now, the NFL season is young right now. However, so is, and perhaps there is a lot more life to it. Depends upon the trajectory of their relationship, I suppose. But so, too, is the relationship between Travis and Taylor Swift. I believe the conversation was brewing. What do we call them now? This new famed couple, Taylor and Travis. I don't know if there's a combined name we've seen out there yet, but no doubt.
Do you have any ideas?
Trailer just doesn't work.
It does not work. But you just saw it on that chart, our chart of the day, by the way. If you can put that back on the screen, just how much of an impact she has by just showing up to games or really showing up her tour, obviously being mentioned by the Philly Fed. Now Travis Kelce, it's hard to find someone who hasn't heard about the story play out over the last couple of weeks. And you talk about her impact here and going back to what we've seen play out over the last several months. The Philadelphia Federal Reserve mentioned the impact that her tour had on the economy of Philadelphia. Her ticket sales broke Ticketmaster, essentially prompting a congressional hearing. We actually saw both sides of the aisle, some bipartisan agreement on some of the changes that need to be made to ticket sales. And now look at this, her impact on the NFL and what exactly is happening. You mentioned the fact that it was the highest rated game so far this season, really reaching fans that they haven't been able to reach before. We've seen promos built around Taylor Swift, companies, Heinz coming out with a new sauce because she was seen dipping her chicken, I think, into ranch or something like that. And that's expected here over the next several weeks. So Taylor knows no bounds.
I mean, look, for the NFL, if you look at this as a opportunity to lean into, it's essentially kind of taking the past few years that the NFL has seen kind of its own issues that it's had to work through. And now you've got this moment where you can essentially kind of celeb wash those years, at least for the interim period of time, for people who forget about that and just look at the spectacle of the new big relationship that is Taylor Swift and Travis Kelce. But it's great to see kind of a number of new fans perhaps coming into the game that could net out positively. It has netted out well for Travis Kelce jersey sales out there. For those wondering who the Chiefs play next, they play the Vikings. So if you're looking for a good game, good little kind of slinger of two quarterbacks, that could be it. And Taylor Swift might be there. Who knows?
Yeah, jersey sales for Travis Kelce up 400%. His podcast hitting #1 on the Apple charts, all because of Taylor, at least for now. All right, guys, we're going to leave it there for us today. Let's take a quick look at the markets before we let you go. Still a mixed picture. The Nasdaq trading in positive territory, up nearly 0.5%. The Dow off about 167. We'll see you tomorrow.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. The government narrowly avoided a shutdown for now, but there's still a key issue missing from the stopgap bill. We'll discuss. And SAG-AFTRA is expected to resume talks today after writers reached an agreement with studios last week. What this means for the industry coming up this hour. Plus, after 3 years, millions are faced with the return of student loan repayments. We'll break down how this could impact the U.S. economy. But first, let's take a look at how the markets are faring an hour and a half into the trading day. Looking at a mixed picture here, a lot of volatility this morning as we're starting off this new month and this new trading quarter. The Dow currently off about 115 points, or about 1/3%. S&P 500 there down ever so slightly, about 0.1% there. Tech-heavy Nasdaq there, the only one seeing some green there, up about 0.5%. Also seeing a little bit of activity as September's ISM factory index, which measures the monthly change in production levels across the US economy, that rose to 49 versus 47.6, which was expected at about 47.9. Let's also check in on the Treasury market as well. We saw a pullback ahead of that government shutdown, regaining some ground here though. Now looking at the 5-year up up over 2% on the day. The 10-year also up well over 2% there as well, currently at 4.67, and the longest term 30-year yield, that's up about 1.7% on the day. Well, President Biden signed a stopgap spending bill on Saturday with just minutes to spare before the government shut down. Now, the new bill funds the government for 45 days. Congress will have to come together to put something longer term in place by November 17th. Now, the stopgap bill includes disaster relief funds as well as funding for the FAA, but it has no additional aid for Ukraine. Now that the weight of the shutdown has been temporarily lifted from House Speaker McCarthy's shoulders, he faces another challenge, a possible ouster from the far-right members of his party. So what can we expect from here on out? Well, to weigh in on this, we have Brian Gardner, Stifel Chief Washington Policy Strategist, and Shai Akabas, Bipartisan Policy Center Director of Economic Policy. Welcome to you both. So it was a bit of a nail biter here. A lot of us were, expecting a shutdown, but this 11th hour saving here. So, Brian, I want to talk about where we go from here, what this period of time buys here for Congress.
It should buy them a little time to get some of the appropriations bills that fund government agencies finished. But that's probably a pipe dream. I mean, the whole debt ceiling deal back in June has a mechanism that was supposed to buy Congress time to finish the appropriations bill. That mechanism failed. I think this purchase of a couple of extra weeks, 6 extra weeks, will similarly fail and will probably be back to where we were last week in the middle of next month, debating a government shutdown again.
So then, Shai, as we look at some of what was scrapped, the $6 billion in aid for Ukraine, and when we look at what was actually resolved in here, $16 billion in federal disaster relief, as well as some provisions here to reauthorize the FAA as well. Was this a win for Republicans, considering what they wanted, some of the cuts that they wanted, and they were able to at least gain some ground here?
I'm not sure it was much of a win for anyone, but we came to the brink of shutting down the government, which is a highly inefficient outcome for everybody involved. And we've only staved that off for 47 days. So we're going to be right back here again in the middle of November. What I think we need to take a step back at and look at is that we have gotten into this cycle of budgeting by crisis. It's lurching from one crisis to another. As Brian mentioned, we had the debt limit situation for the first half of this year, which took all the oxygen out of the room. For the last couple months, it's been shutdown city. We're going to be right here again in 6 weeks, and who knows what comes after that. What this is eliminating attention from is the bigger budget problem that we have as a country, where our debt continues to rise. It's about the size of our economy right now, the debt that's held by the public. And there's no opportunity for Congress to really revisit that and look at the fundamentals and try to consider changes, because all we're doing is trying to keep the lights on and not default on our obligations.
And Brian, as we look ahead, as we potentially can still keep the lights on, I want to talk about the fate of Speaker Kevin McCarthy. I mean, he needed Democrat support to push this through. And then you have Senator Matt Gaetz, ironically, then also turning to Democrats in an effort to really try and oust him. What's the likelihood that we'll have a next speaker by the time the next shutdown showdown happens?
It's a great question. So in the short term, I think it's probable, not definite, but probable that the speaker survives. Going to have a vote probably this week or next. And I think there are probably 10 to 20 Republicans that would vote to oust Speaker McCarthy. But there are also a big block of Democrats, kind of the more centrist Democrats who come from swing districts, who don't want the dysfunction that comes along with kicking out a speaker and what would go along with that. It's one of those things that, they don't want to help Republicans, but they don't want the backlash of dysfunction coming back and slapping them. So I think on this vote, McCarthy probably gets through with some Democratic support. The problem for him going forward is, if there are subsequent motions to remove him, and there probably will be, the price of Democratic support is going to get higher and higher for him. And that's where it's going to get interesting. So I think he probably survives this week. But to your point, to your question, where's he going to be in the next couple of weeks? That's a bigger question. I think he does survive all of this, but the further out we go, the more votes on to remove him, the less confident you can be that he actually survives this this episode.
And Shai, it's hard enough when you already have infighting within your own party, and then you also have your own economic priorities for Republicans versus Democrats more broadly then. So what should be the economic priorities that you expect Congress to focus on between now and then?
Well, Congress has its work cut out for it this fall, in part due to their own making. They still have to deal with the Ukraine question. There was no aid for Ukraine, as you mentioned, included in this package. The House has made very clear that border security is going to be a priority moving forward. So the two sides are going to have to strike some sort of deal there in order to unlock that Ukraine aid and potentially in order to keep the government funded beyond November 17th. They have the underlying question of government funding and not only a continuing resolution, which just keeps last year's priorities in place, but actually the appropriations, the priorities for this coming year. And getting that all done at the same time that this speakership mess is going on is going to be a real challenge. I don't know if they're going to be able to get it done in the next 47 days. In all likelihood, they may need another extension. Often Congress doesn't get this done until December. There are a number of other priorities that are getting shoved aside in order to get these essentials done. So it's really causing a logjam in terms of the functioning of Congress.
And Brian, I do also want to quickly ask you, because obviously a new term for the Supreme Court as well, in terms of economic priorities you expect to come up, especially for consumers coming up this term, what are you watching?
So two things. One that came out this morning, which was frankly a surprise to me. We were looking to see if the Supreme Court would take a case in New York on New York rent control laws. They decided not to take that. I am admittedly surprised by that. The other is a case that they've already scheduled to hear oral arguments in the coming weeks on the funding structure of the Consumer Financial Protection Bureau, the CFPB, and what happens to CFPB going forward. For those who don't know, not to get too deep in the weeds, but CFPB gets its money from the Fed, not from Congress or not from user fees that other agencies fund themselves. And I think the court's going to take a really close look at that, and they may force Congress to restructure how the CFPB is funded going forward. So that has implications, because if Congress has to winds up appropriating money directly to CFPB in the future, it gives Congress more leverage and can kind of lean on CFPB in certain directions to affect their policies and their regulations. So that's a big case to watch. It'll be oral arguments in a couple of weeks and probably a decision sometime in the first half of 2024.
Congress certainly has a full plate indeed. A big thank you to both of you for joining me this morning. Brian Gardner and Shai Akabas, thank you both for your time this morning.
Thank you.
Well, could X, formerly known as Twitter, go public once again? Yahoo Finance senior tech reporter Dan Howley is here with the latest and why billionaire investor Bill Ackman may be involved. Hey, Dan.
That's right, Rochelle. This is part of Bill Ackman's push for what's known as a SPARC, or Special Purpose Acquisition Rights Company, similar to a SPAC, but slightly different. He got the vehicle basically approved now. And so what he's trying to do is look for ways to put it into action. And so one of them that was brought up to him was whether or not he would invest in X or a part of X. He already does have some money in the company, but this would be a larger investment. Part of it potentially would involve paying down some of X's $13 billion in debt. But I think the bigger question is, would there be an appetite for X as a public company? You have to remember that the revenue is down as a result of advertisers pulling back because they're unsure about Elon Musk and his future, despite the fact that We have Linda Yaccarino running it as far as the overall company goes, and her being so popular in the advertising space, or so important in the advertising space. But still, it seems that it's not really where it should be. And so would people actually be interested in going along with an investment in X? Elon Musk is regularly tweeting different ideas. He was recently live streaming the game Diablo 4 to see if he can live stream games. That would allow him to take on the likes of Amazon's Twitch. But, I think before you kind of get into those kinds of features, you have to try to get the advertisers back and more people interested in the platform again.
And then, of course, we remember when Musk first bought Twitter, there was all this concern, especially from Tesla investors, is this another distraction? And it does seem like every 2 seconds Musk is doing something. He was at the border the other day, and as you mentioned, live streaming as well, as he tries to turn X into this everything app. You've talked about the appetite here. Do investors, especially Tesla investors, want X to be now front and center again, potentially as a priority for Musk, or, as a public company?
That's a really good question. I mean, look, Tesla obviously is the more important company here. SpaceX, more important company for investors. Obviously, it's Tesla, though. And so, yeah, I mean, if he is fully, distracted again by Twitter or X, whatever you want to refer to it as, I think that may give Tesla investors some pause. There was, questions when he originally took over the company of whether or not he would be able to separate the two in his mind, or whether he would go full in on X itself. And for a while, he did seem like he was giving X all of his attention. Now it seems as though he's back with Twitter and X, or Tesla and SpaceX. And I mean, it's really difficult to tell how people would respond as far as Tesla investors go to a broader investment in X and seeing it really kind of take on a life of its own as it goes back into the public markets. But the reason why he took it out of the public markets to begin with was so that he could have full control. And I don't know if he necessarily wants to give something like that up again.
That's true. I mean, and as you mentioned, they're making a lot of changes. We'll see if he wants to dive back into that pool once again of going public. Thank you for that update, our very own Dan Howley. Right, I'm watching shares of Nvidia this morning popping after Goldman Sachs added the stock to its flagship conviction list, a step up from the buy rating the bank gave the stock in late August. The Goldman analysts saying they expect the world's biggest AI chip maker to maintain its status as, quote, the accelerated computing industry standard for the foreseeable future. Also added to Goldman Sachs America's conviction list include cybersecurity group Okta, industrial supply group Cintas, and biotech company Quanterix. Meanwhile, they removed Salesforce and Johnson Controls from that list. All right, all your markets action is still ahead. Stay tuned. You're watching Yahoo Finance.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement. What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story. What does all this mean for you?
Keep it tuned into Yahoo Finance.
Pending home sales sank in August, down 7% from July. But even as high rates are keeping buyers on the sidelines, it's still a seller's market. Joining us now on this is Yahoo finance reporter Danny Romero. Danny, what are you tracking right now?
Rochelle, there are more buyers than sellers. Realtor.com says it's a seller's market. If you price your home sharply, you will get bites. And in turn, those home prices will go up. But if you price your home a little too high, it's going to be sitting on the market for a lot longer. And there are several factors that weigh into this supply and demand dynamics. One, mortgage rates are hovering over that 7%. They've been doing that for over a month now, really hindering purchasing power. Second, home prices have climbed about 4% over the last year, the National Association of Realtors reported. And lastly, inventory. There's so little of it. Total housing inventory at the end of August landed at 1.1 million units. That is down 14% from a year ago, the National Association of Realtors reported. And to give you some context of a seller's market, I'm currently in the process of purchasing a home from a veteran, and the seller has an assumable loan. Well, I thought I was going to assume a lower interest rate. Well, that's really not the case now. If this transaction actually goes through, then the veteran would lose its entitlement to their next home that they are moving to. So this really doesn't work out for me to assume their loan of this home that I'm currently looking at. So there are a lot of factors right now, Rochelle, when it comes to the market and whether or not to buy a home. I'm dealing with that right now.
It's true. I mean, people holding on tight to that equity in their homes. So it's interesting to see that it's still a seller's market. And according to Realtor.com, this week is the best week to buy a home in 2023. Break that down for us. Why?
Rochelle, we are entering the prime time of the year. That's what Realtor.com says, from October 1st through the 7th. And the reason why is seasonality. Economists at Realtor.com expect that this time of year, 17% more active listings will be added to the market. And it also is a perk for buyers. Some buyers have actually accumulated about $15,000 from the summer months. That's according, obviously, to this survey. But this also depends on the priorities of the buyers and the sellers. And like I said, I mean, I'm a prime example of what's going on when it comes to priorities. Is this a time to buy? Is it a time to sit and wait? That all really depends on the buyer and the seller, but also the communication between the two. I've really found out that is critically important when purchasing a home.
Certainly a very different space we were in versus the pandemic when it was, I'll buy all cash, waive everything, and now people having to be a lot more discerning. Well, hopefully some more opportunities will open up for people to buy this October. Appreciate that update, our very own Danny Romero. All right, we have all your markets actions still ahead. Stay tuned. You're watching Yahoo Finance.
You have tons of great economic analysis, markets analysis as well, but you're also training for the New York Marathon. What is your number one tip for all the runners out there that are perhaps trying to get their miles in and see you when they're running throughout the 5 boroughs here in New York later?
Yeah, well, first of all, you have to be really determined to do it. Do not give up, because as much as it can be very painful and exhausting, when you get through that, you feel great. So just keep going. And keep training with consistency. You can't slack off, so to speak. You got to do it every other day, I would say, or every 2 days, and really put in the work. You'll make it.
This week, a highly anticipated criminal trial we're watching. Sam Bankman-Fried, former CEO of bankrupt crypto exchange FTX, goes to trial to defend 7 felony counts of fraud and conspiracy. If convicted, he could face a lifetime in prison. The FTX exchanges were once valued at $40 billion. For more on this, Yahoo finance reporter Alexis Keenan getting us up to speed. Hey, Alexis.
Hi, Rochelle. So yeah, serious charges here that Sam Bankman-Fried is facing. It is set to begin tomorrow in a Manhattan criminal court. Day one, that'll consist of jury selection. There are 12 individuals who need to be selected by the parties in order to decide if the 31-year-old Bankman-Fried is guilty or not guilty, as he has pled to those 7 counts of fraud, conspiracy, money laundering. Now, prosecutors say that all the way back to when FTX was founded in 2019, that Bankman-Fried was routinely stealing funds on FTX's exchanges, both internationally and the U.S. exchange, that belonged to customers. The prosecutors say that he then used those funds to pay debts of his crypto hedge fund, Alameda Research, and also for personal expenditures, including buying lavish luxury real estate in the Bahamas. Now, the trial is expected to still reveal, though, some murky details about what Bankman-Fried and others at the company knew about these allegedly questionable financial transactions. Remember, it was back in November when a run on the FTX deposits, on customer deposits there, exposed that the 2 exchanges were insolvent. It was after that time. And still now that the company is fighting a bankruptcy and trying to claw back as many assets as they can in order to pay both their investors, those that had deposits, as well as their other creditors. Now, though, the major hurdles for Sam Bankman-Fried, of course, is what we're all talking about, is that there are 3 former executives of the company who are set to testify against him. These 3 executives have already entered guilty pleas to multiple fraud counts. They are Caroline Ellison. She was the former CEO of Alameda Research, and also Bankman-Fried's former romantic partner, also FTX co-founder and Alameda co-founder Gary Wang, as well as Nishad Singh, the FTX's chief engineer. Also, some questions about whether Bankman-Fried will testify. We don't know that detail yet. And we also don't really know what his defense is, though. On Wednesday, after jury selection is completed, that's when the trial is supposed to get underway with opening statements. And it's at that time when his defense attorney will stand up and tell us a roadmap, a story about what his defense is. So we should get some ideas as of Wednesday. But as you said, convictions on these charges, they are serious. They could land Bankman-Fried for a lifetime in prison if he were convicted on all of those counts. Rochelle?
And Alexis, which of these charges has the heaviest sentencing attached?
Yeah, I think we may have a list of them there. There are multiple counts of fraud that carry 20 years each as a maximum penalty. Now, defendants, even when they are convicted, and we're not at that stage yet, they don't typically get the maximum allowed under the sentencing guidelines. But when you start to add up a lot of charges, if there are convictions on multiple charges, as we have here, we have about 110 years maximum in prison on these charges. That could be very problematic if there are convictions really in any of these charges.
I know you've been keeping us up to date on all of that. I mean, what a fall from grace here for SBF, indeed.
Absolutely.
Appreciate you joining us this morning. Alexis Keenan, Yahoo finance reporter. Thanks so much. Well, the government shutdown was averted, at least for now. As our debts, though, continue to pile up and inflation rises, the markets are nervous of an upcoming recession. It's hard to tell how the markets will end this year. Eddie Gabor, CEO and co-founder of Key Advisors Wealth Management, is here to tell us what he sees for the remainder of the year. Good to have you on, Eddie. So avoided this government shutdown, at least for now. I mean, markets were relatively unfazed about the idea of a shutdown anyway. So as you give your SWOT analysis of what you're focusing on for the rest of the year, let's start with the strengths here. What are some of the strengths that you see in the current market?
Yeah, so look, I mean, I think the strength that the market has in regards to having a year-end rally is the fact that the recession is going to get punted to next year, in our opinion. And there's probably been a lot of money managers and investors that have really underperformed due to the beating that they've taken in certain sectors like bonds and whatnot. So you could see a flow of funds pour into the equity markets and get that Santa Claus rally that so many are accustomed to seeing. And I think there's a likelihood that we could see that. Short term, I think we have more downside pressure to go due to some of the economic data and inflation data we're going to get over the next couple of weeks. So I expect October here to be pretty volatile. But again, if we can get through that noise and get through the Fed, I think there's a high likelihood that you'll see the markets rally at the end of the year.
And Eddie, I want to talk weaknesses here. I mean, we already started to see some cracks, especially for the consumer, and then we're going to have student loan repayments kicking in as well. What do you see as the biggest weaknesses that perhaps the markets aren't really pricing in correctly right now?
So look, the biggest thing that I am very concerned with is the cost of capital, okay? Rates are staying high, and this market is not going to get any direction to the upside until interest rates calm down. I mean, look at the bond market. I mean, I think it's safe to say that we've seen a crash in the bond market. And you look at the returns over the last 2.5 years, if we're negative again this year on long-term treasuries, that'll be 3 straight years of negative returns on long-term treasuries. I don't know if that's ever happened before. So this cost of capital, in my opinion, is going to be a real problem, and ultimately is what's going to put us into a recession next year. And so there's a lot of weakness there because I don't think that's fully priced in. I think there's still a lot of folks that really think the Fed's going to be able to navigate a soft landing, but it's math. And when you look at the cost of capital and families that have to refinance debt or have their floating rate loans that have gone 2 and maybe 3 times by the time we get to next year, how is it possible that these companies and families can continue the same amount of discretionary income? So ultimately, the unfortunate reality, in my opinion, is with inflation staying sticky high and possibly accelerating, and some needing rates to come down and inflation to come down, the only way that's going to happen, in my humble opinion, is a recession. So again, we think you could get a rally at the end of the year, but that would really be a trade for us because I would be concerned going into next year.
I mean, that's certainly understandable, especially looking at the data that we're seeing about, household savings right now. I do want to ask you about opportunities, perhaps to buy the dip, or perhaps some people saying cash is king right now. Where do you see the opportunities in the coming months?
So on a short-term trade perspective, we have bought the dip in energy. We actually bought a little bit today. I think if we get that year-end rally, you could see that trade work because, again, I think oil is going to stay high whether we go into a recession or not. So it's kind of like hedging your bet on if the recession comes earlier than you anticipate. That's an asset class that could potentially do well. But let's face it, if we get a sell-off and the VIX shoots up into the mid-20s, 30s, there's going to be very few things that work. And look, I think investors for the first time in a long time can get a handsome yield on fixed interest rate products for the first time in a long time. So we have a very heavy position in money markets because of that yield. So there's winners and losers in this high interest rate market environment. And I think you can construct a portfolio over the next 6 to 9 months that could generate a tremendous amount of cash flow for investors because of yields you're getting in the fixed interest rate market, eventually the corporate debt market, and then also some of these stocks that have taken a beating where you could potentially get 6 to 8 and 9% yields on dividends.
And of course, have to talk threats here. I mean, we've seen a lot of the tech stocks really bringing up the rally so far this year, paring back a little bit of uncertainty there. But when you look at some of the threats ahead, is it mostly about whether or not the Fed will raise hikes? Because as you're saying, if we're expecting recession now somewhere in like mid-2024, what is it that you're watching the closest when it comes to threats, whether it's some of the domestic ones or perhaps some of the slowdown and impact we might see from China as well?
Yeah, look, I think right now we're seeing areas around the globe really slow down and heading into a recession. So, of course, that's a concern because we are a global economy. I really think the Fed is a non-factor in the near term. I mean, look, the bond market is taking over. The bond market is telling us that inflation is going to be a problem, which is why we have seen that acceleration. And so to me, that's a big red flag. So the Fed may raise rates one more time. I think next week when we get inflation data, that will really be a sign as to what they're going to do. But we know they are close to the end of that rate hike cycle. But the biggest issue is I don't think they're anywhere near cutting rates. And that's ultimately been a bullish case for folks, is saying that the Fed's going to cut rates. And I've said this repeatedly, they're not going to cut rates until something breaks. And that's just the tradition of what they've done. And that ultimately will be a recession that, again, I feel very strongly that we will see next year.
It's true. A lot of that enthusiasm, remember at the beginning of the year, talking about rate cuts coming in 2023. Certainly, the Fed has been throwing cold water, and we'll continue to get some more Fed speak this week as well. Appreciate you taking the time to join us this morning. Eddie Gabor, CEO and co-founder of Key Advisors Wealth Management. Thanks so much.
Thank you for having me.
All right, well, pivoting to some positive crypto news. Now, September is typically a bad month for the markets, but now we're in October, or some may call it Uptober. Now, this historically is a good month for cryptocurrency, and it seems like Uptober, what the crypto industry calls the spike in shares in October, now that's in full swing. Bitcoin reaching a 6-week high this week. Now, that's after staying relatively stable this year. The company spiking 5% just 2 days into the month. October has typically formed yearly highs for the cryptocurrency. Now, also taking a look here, it's really only been in the red twice in October. That's since 2013. And that isn't just limited to Bitcoin. Even smaller crypto companies like Ether, Litecoin, and Solana have also seen a bump. Bitcoin is at about $28,000 per share right now. Right, oil markets action still ahead. Stay tuned. You're watching Yahoo Finance. Although the writer's strike concluded last week after reaching a deal with studios, the actor's strike continues, with SAG-AFTRA expected to resume talks today. Yahoo Finance's Alexandra Canal joins us with the details. Alexandra, so what are the hopes here? What are the expectations?
Well, the expectations are high, especially coming out of the writers' strike, which the writers were finally able to nab that deal with studios. But we're not out of the woods yet when it comes to the actors. And there are several hurdles that the Guild will have to get through in order to get a deal done. So SAG-AFTRA, as we know, it's a union that represents actors, but also represents broadcast journalists, dancers, other types of performers. And what you're seeing on your screen now is what they're ultimately fighting for: more protection surrounding artificial intelligence, increases to minimum pay rates, boosts to streaming residuals, and improved working conditions. So very similar to the writers, but you have to remember that ultimately the Writers Guild and SAG-AFTRA, they are two completely different guilds, and they have different wants and needs. For example, if you just look at artificial intelligence, that's especially problematic for background actors. So there's a particular need for those types of protections on the actor side. And heading into these negotiations, SAG-AFTRA, those union members, they certainly feel emboldened, especially after the writers were essentially able to get a lot of what they were fighting for. We'll see if the actors can do the same as these talks restart, and hopefully we can get the actors back to work and get Hollywood fully operational again.
And Ali, of course, speaking of Hollywood, there's another blockbuster tour film heading to the big screen. What can you tell us about it?
Yes, Beyonce's Renaissance tour, it was a huge deal this summer, is joining Taylor Swift's Eras tour when it comes to debuting on the big screen. So AMC confirmed the news early this morning. Shares initially went up on the news, but took a leg down and reversed some of those gains. But we saw competitors like Cinemark along with IMAX rise on the heels of that announcement. And like I mentioned, this comes after Taylor Swift's Eras tour movie will also be debuting in theaters starting next Friday. And it's a big relief for a lot of these theater chains, which have really struggled to fill the rest of their box office theatrical slate through the end of the year amid those Hollywood strikes. We already saw the Dune sequel, which was supposed to debut in November, be pushed to 2024. And there really isn't much else on the docket for the fall. But now we have Taylor Swift, we have Beyonce. Yahoo Finance spoke with IMAX CEO Richard Gelfond last month. He said that pre-sale tickets for the Eras Tour movie had already exceeded 65 million, and it could be possible that this could be a $100 million film, which would just be mind-boggling considering this was a last-minute addition to the slate. If you take a look at tickets you were just seeing on your screen, Beyonce Renaissance Tour movie tickets are going for $22. Eras Tour movie tickets are just under $20. So that's a little pricier than your average theatrical ticket. But again, a good thing for theater chains, which are still lagging those pre-pandemic levels, and certainly will boost the global economy, I think, in the fourth quarter, just like we saw in the third quarter with those U.S. domestic tour dates. So I'm excited for it. I think it's nice that we're getting to experience these concerts, because I know I wasn't able to get tickets for either one of those tours, and now you can go to the theater and essentially be a part of it, which I'm a fan of.
It's true. I got last-minute Beyonce tickets on the cheap, but I can tell you there's an entire class of fifth graders already have their tickets for Taylor Swift. So I think you're going to expect to see some of these really huge groups and really make it an experience. I mean, you've got the sound, you've got, great visuals. I think this is a win-win, and especially for fans who weren't able to make it to the concerts. We get to sit back, and for those of us who were able, we get to relive it because, all the different tours had something a little bit special in every city. So we get to bask in it all. I appreciate you getting us up to speed. Ali Canal there for us. Well, the only thing worse than a Monday is a Monday with a new bill to pay. And that's the reality for tens of millions of Americans this morning as student loan repayments resume. Personal finance experts will be quick to tell you there are options. Reaching out to your provider is step one. Now, the outlook might be a bit more limited for the multinationals, depending on younger consumers, splashing out on sneakers and apparel. Jeffrey says the return of student loans could be a, quote, key pain point for consumer stocks. The firm recently downgraded Nike, Urban Outfitters, and Foot Locker on the weaker outlook, though it does see opportunities in other areas. So how big a hit can we expect to see all around? Well, joining us now is Thomas Simons, Jeffrey's U.S. economist. Thank you so much for joining me this morning. So first, give us this breakdown as we look at the most impacted sectors and companies that come from borrowers now having to come back in with these repayments for their student loans.
Yes, good morning. Thank you for having me. It's a very difficult question to answer because, at the base of it, the sort of group of people who have student loans is actually much more diverse than we realize, right? It's not just, I think it's easy to think of them as just students and younger people, but not only that, it's also the parents of people who are in college, even the grandparents sometimes as well. And, it's also, I think, easy to think that most people who have student loans are also college graduates, but there's also a really significant cohort of people who paid for a year or two of college, borrowed all the money, and did not end up with a degree. So it's very difficult to sort of put a sort of, kind of signature around what this economic cohort really looks like and what they spend on. But I think it's fair to assume that most of them are kind of like upper middle class. And the trend that they're going to be experiencing here in 2020 and the end of 2023 and beginning of 2024 is trade down, trying to find ways to get by with consumption, just spending a little bit less on prestige brands and, pulling back a little bit on consumption overall, because really this functions like a tax on them, something that they really hadn't, budgeted for prior to this month, I wouldn't think.
And some people might not be aware of perhaps some of the changes. A lot of these loan services had changed versus where we were when the student payments were paused. What should people do in terms of their first checklist of what to do if they have student loans and they really haven't thought about them over the past couple of years?
Yeah, I mean, there's that's a really significant issue. I believe I've seen statistics that are kind of all over the place on how much servicer turnover has gone on. But even some of the bigger payment processors from before are no longer handling the debt the way they were before. So absolutely, first thing to do is check in with who you were, servicing your loan through, and see if there's information about who has assumed your loan, see what their terms are, and make sure that all the automatic payment, drafting structure is in place. But also on your own budgeting side, be prepared to figure out how to carve out this extra money from your monthly flow, and make sure also to take a look at what options are available from the government in order to sort of ease back into payments. This is one of the things that Biden was able to get through in the whole rigmarole over the spring with student loan issue, is that there are modification programs that are much more easier to sort of follow up with and much more successful, or probably will be much more successful, I should say, than previous versions. And also, if you are unable to pay for a month or two, there's, that late payment isn't going to be, reported to a credit agency for a whole year. Thing to keep in mind is that if you are not paying, that you are accruing interest and your balance is going to grow. It's not like it was in 2020 and through 2022 when the interest moratorium was in place.
Indeed. I mean, and people might not know that interest started kicking in and accruing September 1st. So even though student payments are coming up, that interest already continuing to accrue. I do want to ask you, though, some of the big winners. Obviously, we know that as people are going to have to pull back on some of their discretionary spending, won't have as much to spread around. What about some of the companies that benefit from this resuming?
So, there was a lovely graphic that we had on a few minutes ago about a couple of the companies that we've upgraded here at Jefferies. And really, I think, for my own personal view, and I should say I'm not an equity analyst, nor am I, specific to single names here, but I do think that the discounters are the ones that are probably going to pick up most of the slack, right? So I mean, it's Walmart, Target, TJ Maxx, like we have there. They will benefit in that big trade down. Costco is an interesting one because I know that their membership tends to be mostly college graduates. They for whatever reason, they just tend to like shopping there. But I don't know if that means that there's maybe some risk within their customers. But certainly, if they're just trading down brands, it's a discounter in bulk shopping should be doing better as well, I would think.
I mean, you would think so, especially the timing of still have high interest rates, people trying to save for homes. Certainly a whole perfect storm here of issues here for consumers and borrowers. I appreciate you taking the time to join us. Thomas Simons, Jefferies U.S. economist. Thanks so much.
Of course. Thank you.
All right. All your markets action ahead. Stay tuned. You're watching Yahoo Finance. The government narrowly averted a shutdown this weekend after passing a stopgap bill to extend funding to November 17th. But what does this mean for your portfolio? Lawrence Sprung, Midland Financial founder and author of Financial Planning Made Personal, joins us now. Good to have you on the show here. Obviously, a sigh of relief here, but it was something of a wake-up call if you weren't prepared for any sort of shutdown here. Break down first your reaction to the shutdown being averted and how people should be viewing their portfolios, being that we're going to be in the same position potentially on November 17th.
Yeah, thanks for having me, Rochelle. And yes, it was nice to see that they came to agreement, even though it's for a short term. But at the same time, this is something that is more common than I think most people realize. I mean, since 1976, we've had 22 funding gaps, and there were 4 full government shutdowns and several partial ones along the way. So, typically the market's reaction is more nervous going into the event. But at the same time, the markets realize that there will be a conclusion and, an end to the government shutdown at some point. It's just a matter of how long it lasts. So if you look at historically speaking, markets are relatively flat through the shutdown. And then typically 1 year later, we've seen on average about a 12% rate of return from when the market or when the government reopened. So, it was a good thing. I think that we have to be prepared that the potential that it does happen again. I think the one thing we have going for us is we're going to be 45 days closer to the next election, which hopefully cooler heads will prevail and they'll come to an agreement prior to that 45-day deadline.
Indeed. So then when we look at some of the themes that are going to be dominating Q4 this year, I mean, you have a relatively bullish outlook here. What's driving that optimism?
Well, I think, I know your last guest you had on, you were talking about the student loans and those payments starting to resume. And there was some concern over that having an impact on the economy. And in fact, what we saw last week was a report that people are actually paying and started paying those student loan debts sooner, even before the bills were due on October 1st. So that, and we're not seeing an impact yet to consumer spending. So that bodes well. And, looking at historical speaking, when you look at August and September being difficult months, October, November, and December usually are very good months for the market. And we expect the Fed to stay pat. We don't foresee them raising rates any further. So, with all these things at our back, we really feel that, there's a high level of optimism to close out 2023 and going in early 2024.
So then, Lawrence, if we're not going to see perhaps the pain for the consumer showing up in its full glory in this coming quarter, what are your expectations when that does show up, when it does start to pinch, being that we are still in a higher for longer rate environment?
Yeah, I'm not sure that we're going to see that pinch come into play. And, I think we have to put the current rates in perspective. I think we got spoiled over the last 10 plus years with extraordinarily low interest rates. I would argue that the last 10 years or so was an environment that was the uncommon time. And if you look at where we are now, we're in a more normalized interest rate environment to where we were prior to the last 10 years. So I don't see interest rates as high right now. I see them certainly higher than where we were, but in relation to historical perspectives, I don't think they are. And I think there's going to be a little bit of an adjustment period for most folks, especially younger folks who are not used to seeing rates at these levels, and their only knowledge is, rates significantly lower, to get acclimated and understand how this rate environment and how they need to operate in this rate environment that we're in today.
And Lawrence, very quickly, in terms of what people should prioritize then going into this period of higher for longer, although as you mentioned, this is actually what would be considered more of a normal period here. What should they prioritize?
I think, one of the biggest problems or challenges that we've seen is, debt being, increasingly. I think you have to understand that you have to understand your own personal situation and look at what your goals are in the short and long term and start prioritizing them. It all starts with understanding cash flow. That is at the heart of an individual's household. You have to know how much money's coming in, how much money's going out, and where it's going, and look at your assets versus liabilities and what those debts are, and see if you could start reducing those debts, especially because of the rates the way they are, and start tackling them. And you could pick a strategy that is, works for you, whether that's, a snowball effect, picking the smaller debts and eliminating them, or picking the larger ones and just chipping away. But you got to get to work.
Indeed, that's the message. You have to get to work, indeed. A big thank you there to Lawrence Sprung, Midland Financial founder and author of Financial Planning Made Personal. Appreciate you joining me this morning. All right, let's get your final check of the markets, looking at a mixed picture here as we head into the noon hour. That does it for now. I'm Rochelle Akufo. Thanks for watching. I'll see you tomorrow.